Hi, everyone, and welcome along to the Paper 2 Q&A session. Thank you for those of you that are in attendance, and hopefully your exam went really well 2 days ago onwards onto Paper 2. So thank you. Loads of you have sent in questions today, so I will try my very best to get through as many of them as I possibly can. I also kind of want to make sure that I cover in the session topics that I feel are what I call like hot topics that potentially have more chances of coming up. Just to clarify, I had a lot of people coming up to me, go, "Oh, you predicted this, or you didn't predict this." This is not a prediction. I don't think anyone should listen to anyone trying to predict anything. There are certain things that are topical. That does not mean in any way that they will necessarily be asked about. You should be prepared for every eventuality, no matter what they ask. Hopefully at the end of this session, you feel confident and comfortable answering a variety of questions. Okay, right, let's get started. So at the beginning, I wanted to do a couple of Section A questions just to make sure that your theory is really strong on these topics. Starting with index numbers. Index numbers are one of those things where people often don't know how to start or don't know what to do with them. So I just want to show you guys a very quick little technique, and then I'll show you an actual question that we could use to calculate an index number. First and foremost, what is an index number? Well, you should all know that an index number has a base year, which is equal to the number 100. And the whole point of that is that it makes it easy to make comparisons against that year. So for example, I've told you the base year was, let's say, 100. And then the following year, the index number was 107. That would tell you very quickly that the percentage change was a 7% increase because you do 107 minus 100, okay? Right, so watch this as a little method that I want you to basically adopt. Imagine, so ignore index numbers for a second. If I told you guys that there are, so we have kilometers over here and miles over here. And I say, look, for every 8 kilometers, there are 5 miles, right? If you lay out your work in the following way, it will make your life so much easier. Because now if the question was asking me to figure out, let's say, how many kilometers are there in 4,045 miles? How many kilometers are there in 4,045 miles? Right. There's a very easy 2-step process that you follow to always get this right. Step 1 is always to divide, and step 2 is always to multiply. And the only thing you need to remember is that you're not allowed to go diagonally, so you can't go this way. So for example, I could do 8 divided by 5. And then whatever that answer is, I will then multiply that by 4045, and that will give me the answer. Alternatively, by the way, what I also could have done is I could have gone 4045, and step 1 is divide by 5. And then step 2 is I then multiply by 8. The 2 steps will always work. Divide first and then multiply second. It will get you the answer. So it's important to just lay out your work in a very specific way. Right. With this concept in mind, so let's have a quick look at a question. I want to take you through the old spec, Unit 2, June 2013, question 6A, I think, or 1A, sorry. So let me just share screen. Okay, let's have a go. So Unit 2, old spec, June 2013. Okay. Right, so it's a very plausible 5-mark question that you could get in your data response, which looks a little bit like this. So hopefully you guys can all see this. It says, referring to the data in figure 1, calculate an index number for the oil price in March 2012, using January 2005 as the base period. Show your working. Okay, so obviously in the new spec, that would be a 5-marker, not a 6-marker, yeah? So what we need to know is basically how to lay this out in a way that makes our life a lot easier and ensures we pick up all of the marks. Starting with looking at the figure. So where are we? You have, here's the data, here's figure 1. Right, let me zoom in a little bit so you guys can hopefully see a bit clearer. So the data shows oil prices between certain periods of time. So it wanted it, January 2005 was going to be the base, and we want to know what it is in March 2012. Okay, right. What I need you to do is lay this out appropriately. So I will annotate this in a second by showing you exactly how you write this out to make your life easier. What are the 2 variables here? Because remember, in my example earlier, I had kilometers and I had miles, right? Well, the 2 variables here are price, because we're going to know the price, right? So I'm going to do price here. And the other variable is index. I need to express these concepts or these numbers as index numbers. Okay, then we have the following. We have January 2005, so Jan 05, and underneath it we have March 12, yeah? Okay, my method will always work as long as you've got 3 numbers. As long as you have 3 numbers, you'll be able to calculate the 4th number. Well, what numbers do we definitely have? Well, we obviously have the prices because they're literally in front of us. So let's put in the prices first. In January 2005, the price of oil was $45. So we got 45 there. In March 2012, though, It was, I believe, 125. There we go. Right, 125. Okay. Notice that I have two numbers. I need a third number. What is the third number? Well, it told us that the base year is equal to, or is set as January 2005. And what is a base year? A base year as an index is always set to the number 100. Do I now have the three numbers that I need to calculate this? Well, yes, I do. All I now need to do is either 125 divided by 45, and then whatever I get to multiply that number by 100. Alternatively, and it will give you the exact same answer, you're very welcome to check, is to do 100 divided by 45, and then whatever you get there to multiply that by 125. It will give you the exact same answer, which should, off the top of my head, is like 277.7% or something like that. Yeah. So there's that. By the way, do you know what that told us? It basically said that oil prices have gone up by 177%, which makes sense if you think about the maths, because 100% increase in 45 will be 90, and it's gone up by more than that. But anyways, hopefully that's really straightforward in terms of how you calculate index numbers. Yeah. So remember, an index number, you need basically three variables to calculate an index. Now, sometimes they might be a little bit sneaky and actually express it to you as a percentage, and therefore just go, oh, what is it as an index number? So they did this, I believe, in the 2018 paper, where they showed you guys something like, I think, bank lending. And then it said between 2015 and 2016, that had gone up by 4%. And it said, using 2015 as the base year, what would be the index number in 2016? Very annoyingly, by the way, do you know what the answer to that is? Simply 104, because you knew it had gone up by 4%. And if the year before was the index, or the base year, sorry, 100, and it's gone up by 4%, is just 104. Cool? Look out for that question as well. Right, so that's the first little tiny bit of maths that I wanted to do. The next thing I wanted to do is to talk about comparative advantage, and to make sure you guys can calculate comparative advantage based on a data set. In order to do that, though, I actually want to take you guys not through a theme 4 question first. It's a theme 1 question from the old spec, because it does a good job of giving us kind of the introduction needed to go through this. So let's have a look at that. So shared. Right, so back. Right, in the June 2013 paper, unit 1, over here, if it will load, here we go. They had the following question as question number 1, Bob and Wendy, right? It basically says the following. The diagram shows the weekly production possibilities for two builders, Bob and Wendy, Bob the builder, by the way, just out of interest. They each allocate half their working time to decorating bedrooms and the other half to tiling bathroom floors. From this information, it can be deduced that, okay, right. You should all know by now that comparative advantage is where a country has a lower opportunity cost in the production of a particular good or service. And it's important to understand the opportunity cost. Your answer must be expressed in terms of the other good. What I mean by that is, if I want to calculate the opportunity cost of making a bedroom here, I need to ensure my answer is expressed in terms of bathrooms. How many bathrooms would I therefore have to sacrifice in order for this to happen? Right. With this information to hand, I'm going to quickly now share my screen instead, my board, and replicate the data. So we had the following. We've got, oops, right. So we have bed, rooms, bathrooms. And you had the following. You had 4, 2, and this was Bob, and then 4 and 2, and this is Wendy. Okay. This method is flawless as long as you keep your working out laid out in a specific way. Yeah. To calculate the opportunity cost for any player or any particular participant, you need to make sure that the thing that you're trying to calculate the opportunity cost of is on the left-hand side. So for example, if I want to do, let's do Bob first. Let's go Bob. Okay. And if I want to now figure out what his opportunity cost is of making a bedroom, you write bed on the left-hand side of your equation, and then bath on the right-hand side of your equation. Question number 1. If Bob does nothing but make bedrooms, how many bedrooms does Bob make? Well, do you agree that he can produce a maximum of 4 bedrooms? So he's going to produce 4 bedrooms. If he does that, though, how many bathrooms would he have sacrificed? Well, he's now making, if he's there, 0 bathrooms, but he could have made 2 bathrooms. So he's given up 2. Now, I want to express opportunity cost in the concept of 1 bedroom. I want to basically say for every 1 bedroom that he makes, how many bathrooms does he sacrifice? Well, I could therefore make that in the number 1. How did I make 4 become 1? Well, I simply divided it by 4. 4 divided by 4 is obviously equal to 1. I therefore need to do the same thing to the other side. 2 divided by 4, very quick maths, is 0.5. In words then, I've just figured out that for every 1 bedroom that Bob makes, he sacrifices half a bathroom. Okay, let's do the exact same thing for Wendy now. So if we go, all right, bed, bath. If Wendy does nothing but bedrooms, how many bedrooms can Wendy make? Well, Wendy can only make 2 bedrooms, so hers is 2 over here. How many bathrooms does she sacrifice in order to make that happen? Well, she gives up 4 bathrooms. Therefore, for her, for every 1 bedroom that she makes, I divided that number by 2. I therefore need to divide that by 2. She gives up 2 bathrooms. On that basis, who has a comparative advantage in the production of bedrooms? Clearly, Bob, because of the fact that his opportunity cost is lower. Now, you could probably have told that just based on the fact the information is very clear that Bob is better at making bedrooms. She's clearly better at making bathrooms, right? But now let's kind of extend this a little bit so that you have an understanding of why comparative advantage as a theory is very, very powerful. Because the theory says, look, you should now specialize in whatever it is that you have a comparative advantage in and then trade. So let's say hypothetically that now Bob will specialize in making bedrooms and Wendy will specialize in make bathrooms. What is the logical trade that they should now do? Do you agree it makes complete sense for Bob to give up 2 bedrooms and get 2 bathrooms off Wendy? Yeah, assuming their monetary value is constant. Yeah, that means they end up with 2 bedrooms and 2 bathrooms each. But look at that point on the diagram. So if I go up from here, point 2, so from here, and if I go across from 2, I'll put an X there. That is 0.22. Do we all agree? Do you guys notice something? Did you notice that that particular point is outside of both Bob and Wendy's PPF? It was impossible at this moment in time for them to have achieved this by themselves, which is why comparative advantage is a very powerful concept. Because if you specialize in what you have a comparative advantage in and then trade, it should result in a more efficient allocation of your resources and therefore higher living standards for everyone in your economy. Great. That's a little warm up. Let's now get into an actual question based on the specimen paper where they asked you to basically do this little bit of maths, and we'll do it together. So let's have a look at the specimen paper, paper 2. Question number 5. So, 2 and specimen. Okay. So, question number 5 looks like this. Okay, so it says Colombia and Zambia each produce copper and emeralds. The production possibility frontiers below show the 2 countries' productive capacities for these goods. Okay, so we have basically very similar to what I showed you guys with Bob and Wendy, 2 PPF, straight lines. Zambia as 1 and Colombia as the other. Now, A is too easy. I'm not bothered to do that. You guys can do that by yourself later. The question I actually wanted to do was this. It says, using appropriate calculations, explain which country has a comparative advantage in the production of emeralds. Okay, so remember, because I want to calculate the opportunity cost of doing emeralds, we need to ensure that emeralds are going to be on the left-hand side of our equation, and therefore copper will be on the right-hand side of our equation. So let me scroll up. So we've got the data to hand, and let's annotate this together. Yeah. So which country should we do first? Let's start with Colombia because the numbers are a little bit more interesting. So here's Colombia. And remember, I need to ensure that emerald's on the left-hand side. So I'm going to just do E. And copper is going to be on the right-hand side. Yeah? Okay. If Colombia produce nothing but copper, how many units of copper can Colombia produce? Well, clearly, looking at the data, they can make 1,000 kilograms of emeralds. Cool? So I said copper, I meant emeralds, right? If they produce nothing but emeralds, how many units of emeralds can they produce? Well, 1,000 kilograms. And how much copper do they sacrifice to make that happen? Well, they give up 100 million tons of copper. Okay, remember how I said I want to express it in terms of 1. So I want to say for every 1, in this case, kilograms, because look at the variable. So for every 1 kilogram, how much copper do they sacrifice? Well, how did I make 1,000 become the number 1? I divided it by 1,000. 100 divided by 1,000 then obviously gives me 0.1. In other words, for every 1 kilogram that Colombia produce of emeralds, they sacrifice 0.1 million tons of copper. Let's do the exact same thing now for Zambia. Zambia should be very straightforward because of their numbers. So let's do it in a slightly different color. Over here. Okay, so Zambia. All right, we need to lay it out in the same way. So emeralds on the left-hand side, copper on the right-hand side. Okay, if Zambia produce nothing but emeralds, how many emeralds do they make? Well, they make 500 kilograms. How much copper do they sacrifice? Well, they sacrifice 500 million tons. Therefore, obviously, for 1 kilogram of emeralds, how much copper do they sacrifice? Obviously, it's 1. Can you guys see why? So I divided it by 500, divide the other number 500, 1. Who has a lower opportunity cost when it comes to producing emeralds? Very clearly, Colombia. Therefore, Colombia has a comparative advantage. To get the 4 marks, all you have to do is this. You show this maths, And then underneath it, you would write the following to be super safe. You say, Colombia has a comparative advantage in the production of emeralds, as for every 1 kilogram of emeralds they produce, they sacrifice or they give up 0.1 million tons of copper, whereas for every 1 kilogram of emeralds that Zambia produce, they give up 1 million tons of copper. 4 out of 4, easy peasy. Right, let's move. Next. The next thing I want to do before I start doing data responses and 25 markers and all sorts of things is the multiplier, and just making sure that you guys are really comfortable with the multiplier and understand what you need to do for certain questions about the multiplier. I'll do 2 questions really quick. So let's, okay, share. All right. So first things first, quick revision in terms of what the multiplier is. So the multiplier basically is a very simple equation, which is, so the multiplier is equal to 1 divided by 1 minus MPC, okay? MPC stands for, as I'm sure you know, the marginal propensity to consume. It's a fancy way of saying for every additional unit of income you earn, how much of it do you spend, basically, within the economy? It is also the same as saying, or 1 over MPW, the marginal propensity to withdraw, okay? Just want to have a quick word about this to make sure this makes sense in terms of logic. The marginal propensity to withdraw is made up of 3 things. It's made up of the 3 leakages or withdrawals from the circular flow of income. So MPW is equal to the marginal propensity to tax, the marginal propensity to save, and the marginal propensity to import. Okay, so for every additional unit of income you earn, how much of it goes in the form of tax to the government? How much of it do you save and not spend within the circular flow of income? And how much of it do you buy things from abroad, imports? Yeah? Now, if I rearrange this formula, by the way, so if I have that 1 over 1 minus MPC is equal to 1 over MPW, do you agree the tops basically cancel each other out? They're just the same. What I'm left with is 1 minus MPC is equal to MPW. Therefore, if I now rearrange this and take this to this side, do you agree that MPC plus MPW is always going to equal the number 1? Right, let me just rub this bit out. Right, it will always equal the number 1. And I need you to understand very briefly why that makes a lot of sense logically. The concept of marginal propensity is a fancy way of saying an additional unit of income, right? So if you think about it, if I got an extra £1 of earnings, there are only 4 things that I can actually do with my money. 1, I can either spend it in the economy, which is the marginal propensity to consume. Or 2, some of it I actually don't get the whole £1 because the government take it away in the form of tax. So there's 2. 3 is I could save it. I could put it in a bank or I could leave it in my pocket. That's marginal propensity to save. And the 4th is I don't need to buy domestic goods. I could buy stuff from abroad. And therefore, that's the marginal propensity to import. So this is a very important equation to remember, because if you think about it, if MPC is getting bigger, MPW must be getting smaller, and vice versa, of course. So if you get a question, I saw a multiple choice question a couple of years ago about how, I think it says something like the MPS is falling. So if MPS is falling, and just that's all you've been told, that means MPW is also falling, and therefore MPC must be rising. And the bigger the MPC, you can see this in a second when you plug in numbers, the bigger the multiplier will be, which we'll talk about when we do economic development as well. Yeah. All right. Anyways, this is kind of the groundwork in terms of just starting you off with regards to like what the formula is and how to rearrange that formula to show you certain things. Let's have a look at a few past paper questions that asked about the multiplier. It's likely to be a potential Section 8 question if it comes up. So let's start with June 2016, the AS paper, question number 5. Right, here we go. You know how like I talk about certain questions, you go a minute per mark, yeah? However, there are certain questions like this where after this, I expect this to take no longer than 30 seconds. Honestly, like 30 seconds is a push. Up to a minute is crazy, yeah? In 2014, the Bank of England estimated the marginal propensity to consume of UK consumers to be 0.5. In 2014, the Chancellor of the Exchequer announced a £15 billion investment programme into UK road infrastructure. Using the information above, calculate the total increase in national income resulting from the £15 billion investment. Okay, really straightforward, 2 steps, and then gets you the answer. Step 1 is to write out the formula. So we know that the formula is 1 over 1 minus MPC. So let me quickly just put that as a text there. So 1, let me change the color. 1 over 1 minus MPC. Right, plug it in. 1 over 1 minus 0.5 is obviously equal to 1 over 0.5. And that, as far as I remember, is equal to 2, yeah? So that should be 0.5. That's equal to 2. We've just now calculated the size of the multiplier. The multiplier is equal to the number 2. Right. Why do you think it's called the multiplier? It's called the multiplier because you now multiply the initial injection by that amount. Therefore, all you do now for the last step to get the third mark is 15 billion times 2, which I'm pretty sure you could do in your head, it's 30 billion pounds. 3 marks. How easy is that? That's it. 3 marks. Last year, they had as question number 1, a question about the incomes falling. I think it was like a leakage. I told you the multiplier, and you just needed to calculate the fall in national incomes based on that. That was it. You just needed to multiply it by that. Okay, right. That's a nice, easy one. Let's do one more. Let me just clear my drawings, and then let's move on to slightly more complicated stuff than data responses and whatnot. June 2019 AS. Okay. Okay, question 1B. Here we go. Right. Question says, it is estimated that building a second runway at Gatwick Airport will require an investment of £9.3 billion. The total increase in UK GDP as a result of this injection is expected to be around £44.1 billion. Calculate the value of the multiplier based on the data given. You're advised to show you're working. Okay, this time we're just going backwards. Basically, they've done the maths for us. They have multiplied whatever 9.3, the initial injection, by a certain number, which we don't know just yet, and they have got £44.1 billion. Does that make sense? I therefore need to go backwards. So just to clarify what I mean by that is, I don't know what the multiplier is. Is that fair? So I know that the initial injection is 9.3 billion, 9.3, yeah? And that's going to be multiplied by whatever the multiplier is. And we know it's going to give us the number 44.1 billion, yeah? I purposely omitted the word billion just because they're both expressed in billion, so it's fine, yeah? You can therefore obviously rearrange this formula to make 9.3 the subject, or sorry, to make the multiplier the subject. Therefore, you're going to get x, let's call it x, equals 44.1 divided by 9.3. I don't know what that is. Whatever that is the answer. Yeah, you know what? Let me quickly plug it into my calculator. So you're going to do 44.1 divided by 9.3, 44.1 divided by 9.3. It gives me 4.74. Do it to like 2 decimal places. Those are your 2 marks, nice and easy. Yeah, is that clear? Hopefully that's nice and easy, and we can start moving into some more interesting territory. Right. One of the topics that I think is a very hot topic that I think is a very good idea to prepare for in the event that it's part of your data response is trading blocks, and specifically within trading blocks, the Eurozone. They can, of course, ask a question. I mean, they could ask a question about anything, but they could very easily ask a question in regards to the UK leaving the EU. They've got enough data potentially to start talking about the ramifications of that. I think personally, the thing that's more likely, if it is going to be in the data response, is that they talk about Croatia joining the Eurozone. It happened in the last 2 years. There's a lot of data for them to basically talk about, and it could be something along the lines of the pros and cons of joining a monetary union. So for this, given that it's a made-up question, I want to basically take you guys through step by step what you will do for a question like that as a 15 marker. It could also be a 25 marker, by the way. But in a nutshell, we want to go and do the pros and cons of joining the Eurozone or joining any monetary union. Yeah. So we'll have monetary union. Okay, let's chat. A monetary union, as hopefully you all know, is one of the most extreme forms of a trading bloc, whereby it has the following features. There is free trade between member states, so all the countries within the bloc trade freely amongst each other. There are no barriers to trade between them. They have a common external tariff, which means that anyone outside of their members club has to basically pay a tariff to sell goods into those countries. There is free movement of labor and capital, so you could easily move around. There's no requirement to get a visa to go from, let's say, Germany to France. And the last thing is that they also share a common currency. In this case, the Eurozone obviously share the euro as their currency. In terms of the analysis, I think that there are 2 very strong analyses that I would always lead with that I think you can develop very quickly. The first is the concept of trade creation. So number 1, the first analysis I would talk about is trade creation. But in terms of how I would develop trade creation, I think there are some really good chains of reasoning that work specifically for a monetary union. The first is that, do you agree that by being part of a monetary union, firms within that bloc never ever need to worry about unfavorable exchange rate movements negatively impacting their profit margins? What I mean by that is this. Imagine I am a British firm, and so I obviously quote in pounds, sorry. And let's say I'm trading with a French firm on a regular basis who are quoting in euros, yeah? To make our life easier, let's assume that initially £1 is equal to €1, okay? And we have a fixed contract, which means that I sell, let's say, 100 units to this French firm, and I'm going to buy 100 units from that French firm. But the pound against the pound or the euro could basically depreciate or appreciate relative to one another. They can move and they fluctuate wildly, right? As an example, in the aftermath of the mini budget that Liz Truss and Kwasi Kwarteng decided to give us, the pound went into like free fall, especially against the dollar, right? Let's just say, hypothetically, to make our life easier, imagine now that £1 is no longer equal to €1, it's equal to 50 cents, right? So like half the amount. But remember, I'm in a fixed contract, meaning that everything I'm exporting now, I'm getting half the amount for my exports. And everything I'm importing, I'm now paying double the amount. I have to convert double the amount of pounds to be able to buy the same €100 or 100 goods from the euros that I was before, right? Therefore, what's happening to my profit margins? My profit margins are being like completely squeezed. But if I now talk about a country like Croatia, who have recently joined the Eurozone, well, now they trade in the same currency as their main trading partners, the likes of Spain and Italy and France and Cyprus and all of these. They both have the same currency, the euro. Can €1 ever be stronger or weaker than another euro? The answer is a flat no. It is literally impossible for €1 to ever be stronger or weaker than another euro. But this is great for countries that are trading with each other because they never ever need to worry about unfavorable exchange rate movements negatively squeezing their profit margins. This gives firms a lot more confidence as well, by the way. So levels of investment are likely to go up, right? You also can talk about within trade creation, by the way, that countries can now tap into their comparative advantage. They can specialize. And because realistically, the majority of the trade they're likely to conduct is between each other, because geographically they're really close to each other, this is amazing for them because of the fact that it should lead to higher living standards, export-led growth. You have a lot of things that you could talk about here in terms of trade creation. Make sense? So that's the first analysis that I would want you to basically deliver in an essay like this. Now, I appreciate typically for an essay like this, you do analysis, evaluation, and I don't mind. Just for the purposes of covering the analysis first, I want to take you through a second analysis. Number 2, the second benefit of joining a monetary union is that it is likely to result in higher levels of FDI, foreign direct investment. Why? Why would you get more FDI if you're part of a monetary union? And the best example of that, by the way, is Ireland. The Republic of Ireland are part of the Eurozone. Now, a big reason for that is also Ireland have very low corporation tax. By the way, park that thought for later. But they have a very low corporation tax, but they are also part of the Eurozone. So that makes them even more attractive as a destination. Examples of countries that are set up in Ireland, in Dublin, Google, Microsoft, Pfizer, these are all companies that have their European headquarters within Ireland or in Dublin. Why is that? Well, one of the reasons why is because of the fact that A, firms want to take advantage of the easy trading conditions that we just described above. But 2, the second reason why is you would want to avoid paying the common external tariff. If you're Google, Microsoft, Coca-Cola as an example, if you send your goods from the USA into the Eurozone, every single time you do that, you have to basically pay a tariff. You don't want that to happen. So what you do is you set up a factory and create a factory or headquarters within the Eurozone. And the consequences of that is that now when you sell to other members of the Eurozone from Ireland, are you paying the tariff? The answer is no. Hence, you're going to get higher levels of FDI. Now, if you get to the point where you can talk about FDI, this is a very nice chain of reasoning. The nice chain of reasoning from here on is so straightforward. One of the nice things about macro is to bring it back to aggregate demand wherever you can, and you can easily develop the point quickly. Investment is a component of AD, and therefore AD is likely to shift outwards. Investment is also an injection into the circular flow of income, and so there would be a positive multiplier effect. This is the number of times the rise in national incomes exceeds the initial injection that's caused it. Draw the diagram. You can show off with the diagram, by the way, because if there's an injection, you could do something like this. Real GDP, price level here. So Keynesian LRS, so that's not the nicest LRS in the world. AD1, so I'm doing it really rough. Y1, E1, AD2. But watch this. You can shift AD out 3 times. Well, 2 times, sorry. Why? Because the second shift is due to the multiplier effect kicking in. So the first shift was because of the investment that came into the economy, basically TNCs. And number 2 is because of the positive multiplier effect that arises when there is an injection into the circular flow of income. Nice and easy. That's your analysis, yeah? There are other benefits as well, but I think these are very straightforward and they should have data to support you if it is a data response, yeah? Okay, let's deal with the evaluations because they are very specific, especially the first actually, to a monetary union. if you get a question about a monetary union, your absolute must evaluation, it is like imperative that you do this, is to talk about how there is a loss of monetary independence. Right, let me elaborate. Number one, loss of monetary independence. Okay. If you join the Eurozone, how many central banks are there in the Eurozone? There is one single central bank called the European Central Bank. And the European Central Bank have to set an interest rate, a base rate, that works for all the members within the Eurozone. When they set up the Eurozone, they talked about it being like one size fits all. Has one size fit all. One size has absolutely not fit all. Because the great example you can give is for many, many years, in the last like decade, I'm in Germany, aren't doing brilliantly right now, but before that, is that whilst the German economy was booming, the Greek economy was in a deep recession. And now let's apply some of our monetary policy knowledge to good effect and figure out what needs to be done. So imagine you guys are now the central bank, yeah? And I've told you that Germany has high levels of growth. Now, if you have high levels of growth, you're typically operating somewhere over here, like at full capacity or near full capacity. So great in terms of growth, but not so great in terms of inflation, because you're going to have a lot of demand pull inflation possibly. You describe it as like the economy is overheating. What kind of interest rate would Germany therefore need? What would you need to do to Germany's economy? Well, you want to shift the AD curve inwards for Germany. So what do you need to do? You need to raise the interest rate. The logic of which is this: higher interest rates will incentivize people to save their money in banks, because if they save their money in banks, they get a higher return. Therefore, higher savings, less consumption, AD shifts in. Okay, so Germany need a high interest rate. Greece, on the other hand, somewhere over here, by the way, I wouldn't draw this, this is just for purposes. So imagine Greece are like there. What kind of interest rate do Greece need? Well, clearly, Greece need a low interest rate to stimulate growth, because if they have low interest rates, it will encourage people to spend rather than save. It'll encourage them to borrow money and spend that money, and firms to borrow money, all of that. And therefore, AD would shift out. Is it possible to cater to both countries' needs? Well, the answer is no. There is no way of having a set monetary policy tool that deals with the needs of both Germany and Greece here. That is a phenomenal evaluation, by the way. And it is imperative that you understand that and can use that in an essay about monetary unions. Yeah. One of the big, in fact, it's probably the biggest downside, is the fact that you lose monetary independence. That's number one. The second bad thing about a monetary union, and to be honest with you, a good way of figuring out where things lie within the course and how to use certain points is to go, okay, there's a lot of overlap between theme 4 in particular, but also theme 2. In macro, things overlap a lot, whereby this topic, monetary union, comes under trading blocks. Where does trading blocks come under? Well, trading blocks is part of a massive topic, which is globalization. This is like one of the purest forms of globalization because of the fact that countries are very integrated with one another. They trade a lot, all of that. Well, if you can figure out any bad things about globalization, you already have an evaluation. Do you agree that one of the bad things about globalization is that it's resulted in countries becoming too interdependent upon one another? They become too closely connected to each other, to the point where if one of the countries within your trading bloc, for example, let's say Greece again, sorry, picking on Greece a lot, but like if they mismanage their economy, does that only impact the Greek economy? No, it impacts all of the members within the trading bloc. As an example, Greece's debt crisis escalated so much that they needed to be bailed out on several occasions by Eurozone countries. The estimate for how much Germany have contributed towards Greek bailouts, this is about 4 or 5 years ago as well, so the number might even be revised, was 56 billion euros. 56 billion euros Germany have contributed towards bailing out the Greek economy. France have contributed about 42 billion euros. In other words, this is a problem. So number 2 is too interdependent. Yeah. An example of this, by the way, in the context of like just the global economy generally, not just in terms of like a trading bloc, is COVID. COVID, do you agree, spread far more rapidly because the world is so interconnected. There's so much globalization. There's people moving between different countries all the time. Goods are being traded, etc. So one of the downsides of globalization is that negative external shocks can spread far more rapidly because of the fact that the world is basically like one big world, if you like. Yeah, not one small world. Yeah. Okay, that's how you deal with a monetary union question if it comes up. Hopefully it does. That will be amazing. Right. Next. One of the questions I got asked was in terms of, I think, one of the harder questions that you could get. I'm not going to lie. If I was sitting the paper in 2019, I would avoid this question. I would have done the other question. So let me quickly show you the question. It's this. It was a 25 marker. I just want to kind of clarify what it means and therefore how you go about answering the question. Yeah. So here we go. Okay, question number 7. I always talk about how I think there's like a right and wrong option in terms of the 25 markers, other than actually maybe Thursday, where I think both were good options. I don't mind which ones you would have chosen in that exam. The correct answer, in my opinion, of the best response or the better question here is number 8. But because the question that I was asked is about number 7, let's deal with number 7. It says, 3 of Africa's main trading blocs have agreed to form the Tripartite Free Trade Agreement, TFTA. This will create one of the world's largest free trade areas, stretching across 26 countries with a combined GDP of around £1 trillion. Evaluate the effects of the growth of trading blocs, such as the TFTA, on global trading patterns. Okay, not the nicest question. It's not the worst question in the world, but not the nicest. A couple of things to note, by the way, is that they've given the TFTA as an example of a trading bloc. You're not limited to talking about them, nor do you even have to talk about them. There is obviously some data there that you could use, but you don't have to limit yourself to that. Yeah? Okay, what do they mean by global trading patterns? Global trading patterns is just a fancy way of saying where trade is going to be focused, like what's going to happen. Imagine, for example, that you used to basically trade with 5 different countries on a regular basis, and then suddenly you join a trading bloc where it was only one country that was part of that. Well, obviously, a lot more of that trade will go to that country and less to the other 4. Right, let's just quickly create a very quick plan of how to go about answering the question about trading patterns that hopefully addresses this issue. I would probably talk about the EU here, by the way, yeah, as part of the answer at least. So my first analysis is the growth of trading blocs such as the EU is likely to have resulted in high levels of trade diversion. Trade diversion, as I'm hopeful you know, is where trade is diverted away from more efficient countries outside of a bloc to less efficient countries within the bloc. Why? So if you join a trading bloc like the EU, you have free trade between member states. But anyone wanting to sell their good into your country from outside of the bloc now has to pay a common external tariff. And therefore, the goods coming in from abroad suddenly become more expensive. And it's only because of the tariff and nothing else. Really random example. I know the UK has obviously left the EU since, but prior to joining the EU in the 1970s, do you guys know where the UK used to import the majority of its butter? The answer is New Zealand. So the majority of UK butter used to come from New Zealand. When we joined the EU, who did we divert our trade to? France. French butter suddenly looked a little bit more attractive because of the fact that there was free trade with France, whereas with New Zealand, they have to pay a tariff. So you can explain that in a decent amount of detail and explain that there's going to be trade diversion because of the fact that you're part of a bloc. So now it's basically free to trade between countries within the bloc, but there's a tariff. And so the pattern of trade is that now it moves to more trade within the bloc and less trade from outside the bloc. Trade diversion is basically my first analysis. There's a pretty good evaluation to that. The evaluation to that is even with a common external tariff, countries may still have a comparative advantage. So for example, the Ivory Coast has clearly a comparative advantage in the production of cocoa because of the fact that 1, they can produce it at massive scale, and 2, why do they have a comparative advantage? One of the main reasons why countries tend to have a comparative advantage is natural climates. So Brazil, for example, are really good at producing coffee beans because of their climate. Well, the same thing is true for the Ivory Coast. They have the ideal climate for growing cocoa trees. Similarly, Italy have the ideal climate and the right trees to grow olives. So anyways, the point then is that actually, despite the fact that those countries may face like harder trading conditions, in reality, you're going to continue to import your cocoa from a country like Ivory Coast because they have a comparative advantage. Does that make sense? So even with the tariff, even with the higher cost, the pattern of trade shouldn't be that badly affected because countries will continue to have a strong comparative advantage. So that's the first half of the essay. The second half of the essay is to basically just now focus on the trading bloc itself and talk about how there's going to be a massive volume of trade within the bloc. It's now trade creation. So if you join a trading bloc, do you agree the pattern of trade is that there's going to be a lot more trade within that bloc? So the EU, for example, has expanded to have multiple countries. The Eurozone now has 20 countries, I believe, if I'm correct, I'm pretty sure it is, right? So there's going to be a lot more trade between each other. And then you just explain why the barriers to entry have fallen to the point where it's easy to trade between each other. If they have the same currency, it makes them have more confidence about trading as well. So you can even talk about like the Eurozone, yeah? That will be like the analysis. Evaluation is not amazing, but this is not an amazing question, to be honest with you, as a 25 marker. I would evaluate by talking about actually how much trade and how effective the trade is, if you like, depends on how many countries are in the bloc. So for example, certain trading blocks, if they only have 3 or 4 countries, so as an example, in the specimen paper, prior to the creation of the TFTA, there was this trading bloc in Africa called the EAC, and they wanted to basically move into a monetary union. I actually don't know in real life whether they did it or not, but it was made up of 5 countries. It's not really that big a deal, right? So therefore, the pattern of trade may not necessarily be that focused within the bloc if in reality, there are only a small number of countries. I agree, by the way, this is not a phenomenal evaluation, but it's good enough for a question like that. It will suffice, and the analysis is pretty strong here. But hopefully that clarifies in terms of how you would deal with the question, just in terms of understanding what they mean by patterns of trade. Okay, cool. Right, let's take that off and let's move into something that I really want to make sure you understand, exchange rates. I want to make sure that you know how to answer exchange rate questions and that you know how to deal with the consequences of certain things happening to the exchange rate. Starting with the following. So what year do I want to do? Let's do, actually, I want to share my board first. That's what I want to do. So share screen. Okay. I think amongst all the topics across the Theme 4, the topic that students tend to overcomplicate the most and make life so much harder for themselves is exchange rates by miles. And if you just understand how simple exchange rates can be, it will make your life so much easier. Exchange rates should always be done through a supply and demand perspective, yeah? So let's do it from the perspective of the UK. So if I'm doing the UK, my diagram to determine whether the exchange rate will appreciate or depreciate or whatever, it would basically be this. It will have price of pounds in whatever currency you want to compare it against, let's say dollars, and then the quantity of pounds on the x-axis, right? Remember to always draw supply and demand, yeah? Q1 and P1. Okay. I'm going to give you guys some context, and hopefully it will make a lot of sense in terms of why I'm going to shift whatever I'm about to shift. Never ever try to figure out what happens to the exchange rate before you've figured out what the shift is and looked at the shift. Don't try and second guess. So imagine I gave you the context, which is very relevant to right now, that inflation in the UK is high. So imagine that there is high inflation in the UK. Right, word of caution. Inflation is not the same thing as the exchange rate. There's a common misconception here. The inflation rate is the price of goods and services within your economy. The exchange rate is the value of one currency expressed in terms of another currency. They are not the same thing. In other words, you could theoretically be price competitive in terms of your exchange rate, but very unprice competitive in terms of your inflation rate. That is entirely possible. In fact, it happened in the UK. So after the mini budget, the pound was so weak that we would argue that we were very price competitive in that regard, but the inflation rate in the UK was very high, so we weren't price competitive in terms of inflation. Anyways, now we've basically said, okay, imagine there's inflation in the UK. There are two routes to the same answer. I'm going to go through both routes in a second, but price of pounds in dollars, yeah, pounds. But I always want you, I prefer to do the simple route first, yeah? And that is the route that I prefer you to do if it's like a 10 marker or a 12 marker, more likely to be a 10, by the way, than anything else. To go, okay, if inflation is high in the UK, are British goods more or less internationally price competitive? Well, the answer is less, because they're less attractive. If you're someone based in, let's say, France, do you want to buy more or less British goods when the price of British goods is going up? Well, obviously, you can't afford to buy as much. You don't want to buy as many British goods. If there is, therefore, a decrease in the demand for British goods, do you agree that that is likely to translate into a decrease in demand for British pounds? People in the foreign exchange market no longer need to buy as many pounds because they're not buying as many British goods. The demand, therefore, is obviously going to shift inwards. So higher levels of inflation results in less demand for your goods and therefore less demand for your currency. And consequently, what happens? The pound has depreciated. So it's gone down in value. Cool. Let's do the other alternative. I prefer the first version, by the way, but I want to show you the alternative. One of the topics that you could potentially be examined on is conflicts between macroeconomic objectives, which you should know about from last year. Conflicts between macroeconomic objectives, well, one of them is economic growth versus the current account, because as your economy grows and people have more income, they'll spend more domestically, true? That does nothing directly, though, to the exchange rate. So when you and I buy goods and services in the UK, that's not going to influence this. This is the foreign exchange market where there are buyers and sellers of currency. So for example, by the way, if you were going on holiday, you know those exchange booths that you go to? What you would be doing there, by the way, is that you're either buying or selling. So in that case, let's say you're going to go on holiday to Italy, you would be selling pounds and buying euros. So we talk about it as like, oh, I convert my pounds into euros. Yes, but in a conversion, there's always a seller and a buyer. In that case, you sold pounds and you bought euros. Okay, anyways, so we said, look, there's a conflict between economic growth and the current account, because when there's economic growth and people have more money, they're likely to spend more domestically, but that is nothing here. But they're also likely to spend more on buying things from abroad. how do I buy more stuff from abroad? Well, to buy more stuff from abroad, I would need to convert my pounds into like euros. So what I said by convert is I'm selling pounds and I'm buying euros. Okay, so let's go back to our context. Inflation is high in the UK. If inflation is high in the UK and you live in the UK, are you going to want to buy more or less things from abroad? Well, I would want to buy more things from abroad because it's now cheaper relative to British goods. Fair? So what do I need to do? I need to therefore sell my pounds and buy euros, dollars, yen, whatever it is. Hence, there'll be more sellers in the foreign exchange market getting rid of their pounds and buying other currencies. So for the pound, supply would have shifted outwards. And the consequences of that, again, is the pound depreciates. Yeah. Look out for stuff like that. Look out for things like, oh, if there are higher wages in the economy, people have more income. Higher income translates into them being able to import more. So to import more, they would have to sell their currency and buy up other currencies. Right. That's our kind of groundwork, the starting point. I want to now talk about how a central bank could intervene and either fix their exchange rate against another currency, like consistently fix it, or what we call a managed exchange rate, where from time to time they'll intervene to make the currency stronger or weaker. Yeah. All right. To do that, again, I need supply and I need demand. Yeah. There is an extract that I'm going to have a look at with you guys in a second. It's from the 2020 paper 3, and it's about Turkey. Yeah. So Turkish economy, their currency is the lira. So we're going to do price of lira in dollars. And this is going to be the quantity of lira. And here's the price of lira, again, in dollars. And this is the quantity of lira. Okay, right. What I need you guys to understand is that once we draw the supply and demand diagram, if a central bank or a government intervene in the market, in the currency market, and manipulate their currency, so if they manipulate it, it is no longer called an appreciation or a depreciation. An appreciation or a depreciation is basically free market forces, where the example I gave you earlier, inflation went up, so therefore less demand, and there was a depreciation. Cool. This now is going to be called revalue. That's when they make it stronger. And devalue is when they make it weaker. And the best way to remember this is imagine that the only thing that the central bank can do is either shift the demand curve out or the supply curve out. That makes your life so much easier. Before I explain this, I need you guys to make sure that you understand a concept known as foreign reserves. Foreign reserves is a fancy way of describing other currencies within your economy. So for the lira, for the Turks, examples of like foreign reserves for them will be dollars, euros, pounds, yen, etc. Yeah. Now countries want to have a stock of foreign reserves. We'll deal with that later with the foreign exchange gap and development. But in a nutshell, countries typically will want to have a certain amount of foreign reserves, partly because of this, because they can manipulate their currency using it. Okay, let's go through two scenarios. Let's go through scenario number one, where I want them to devalue the lira. If I want to devalue the lira, always start with what the central bank needs to do, and it will make your life easier. So think about what I need to shift. Do I need to shift supply outwards or demand outwards to make the lira weaker? Well, clearly the supply needs to shift out. So they need to basically do this, yeah? So what do they need to do? Does the Turkish central bank need to sell lira or buy lira? The logic is that they are a supplier here, hence the supply curve shifts. So they need to sell lira. And if they sell lira, they must be buying foreign reserves. Simple as that. That's the explanation of how they devalue their currency. They sell their lira, their currency, they buy foreign reserves. Okay, let's do the opposite. Let's revalue. Okay, if I want to revalue, think now in terms of, okay, which direction do I want to shift what? Supply outwards or demand outwards? Obviously, it's going to be demand outwards this time. So demand outwards, D2, D2, P2. How do they do that? Well, step one, remember, think about what they did first. Well, in this case, are they a buyer or seller of lira? Well, they're the consumer because they're the demand curve. They are buying lira from the foreign exchange market. So they're going to buy lira. And therefore, they must be selling the opposite. They're selling foreign reserves. Easy peasy. That is how you manipulate an exchange rate. Now, there are alternatives as well. For example, you can play around with interest rates. So for example, if I wanted to revalue the currency, I could raise interest rates, because if I raise interest rates, hot money flows into my economy. Hot money is basically investors all around the world want to park their money in the bank accounts that give them the best rate of return. So if I'm a multimillionaire, what I'll do is I'll move my money around between banks wherever interest rates tend to be higher. So if I raise the interest rate, hot money flows in. There's therefore more demand for my currency. So this would happen. It would cause the demand to shift outwards. Vice versa, by the way, if I want people to move money out to sell money, I could reduce the interest rate. Because if I reduce the interest rate, people go, I don't want to leave it in your economy. I don't want to leave it in Turkey. I'm going to move my money out to another country. Therefore, they sell their currency and buy other currencies instead. Nice and easy. That is the starting point that I need you guys to understand. If you get a 10 marker or maybe not an 8, maybe an 8, a 10 marker on like reasons for an appreciation or a depreciation of a currency, I need to ensure that you guys are really, really comfortable drawing supply and demand diagrams like this. Make it really simple, shift it in the correct direction, and you can't really go wrong. Yeah? Right. Just to give you some context with a past paper question. Right. Old Spec, Unit 4, June 2016, has an extract about Ghana. Great paper. Let's do it. Cool. June 2016, Unit 4. Ghana. Right. Here we go. Okay. So, right example of a question is this. 10 marker. With reference to the information provided, examine 2 factors which might have caused the depreciation of Ghana's currency, the CD. Now, just to save time, just to kind of illustrate this as a concept, I'm going to show you guys where the answer is. It's a very long extract, by the way, and sometimes what you need to do is kind of almost persevere. It will be there somewhere. And obviously take a highlighter, highlight the correct things. It is this, basically. The whole answer is basically here, yeah? Right. It says the country faces a double-digit fiscal deficit after a 75%, that first bit I don't really care about, 75% increase in public sector salaries over 2 years. Okay, think about what that does. If people in Ghana have a lot more income, they have a 75% increase in their public sector salaries, do you agree they'll buy more domestically? That doesn't do anything directly to the exchange rate. Not interested in that. But they'll also buy more from abroad. How do you buy more stuff from abroad? Well, you would sell your currency, their currency is called the CD, and you buy other currencies. Therefore, you draw a nice simple supply and demand now, and supply would shift outwards, depreciates. And then in the next sentence, it also says inflation is rising rapidly as the CD plunges. Okay. If there is rapid inflation, we now do the following. Ghana is less price competitive. Demand for Ghanaian goods is going to go down. Therefore, demand for Ghanaian currency is going to shift inwards. And guess what? The Ghanaian currency, therefore, depreciates. Your factors. 2. Generic evaluations. This kind of question has generic evals, by the way. Whenever you're dealing with something like inflation, your best friend is the word relative. It's all about relative inflation rates. So even though Ghana may have had rapid inflation, if their main trading partners, their neighbors, have even higher inflation than them, then actually, relatively speaking, Ghana is still price competitive. An example is if you get an extract about, let's say, a South American country right now, let's say Argentina, and it shows that inflation rates are really high in Argentina. You could evaluate that by going, yeah, but actually, compared to like Venezuela, we have hyperinflation. Argentina look amazingly attractive comparative to like New Zealand. Not New Zealand, Venezuela, right? So that is a brilliant evaluation that always works. It's really straightforward. Is that clear? And in a 10 marker, I don't need you guys to do 2 evaluations, by the way. One fairly developed evaluation will basically suffice, and that's pretty developed if you give it some context, yeah? Okay, right. So we've dealt with the first part of this, which is to go through why a currency might appreciate or depreciate. Let's now very quickly, I'll come back to this question in a second. Let's really quickly now look at the question about Turkey that I was speaking about. Okay. I would advise, by the way, in your own time after this, maybe tomorrow or staying up tonight, going and looking at this extract, kind of slower than I am. I'm always trying to cover as much as I can in the session that we have. But this is a really useful extract in terms of understanding exchange rates. So the 2 questions I want to quickly talk about is this. Explain how the Turkish central bank intervenes in the currency market to prevent excessive appreciation or depreciation of the Turkish lira. Right, context. The data was speaking about how their currency had majorly depreciated relative to the US dollar, yeah? And there are obviously issues with major depreciations because of the fact that, one, it's harder for you to service debts. We are going to do this in a second. In fact, forget the reasons why it's a problem for now. I'll do that for question B in a sec. But anyways, if their currency is really weak, they will want to intervene then to, in this case, revalue the currency. Now, you could have, by the way, done it as devalue, if you said that if there was, because it gave you the option of, look, excessive appreciation or depreciation, but you should only do one, yeah? 5 marker, this is how you get 5 marks instantly. The first thing I would do is basically say, according to extract A, the Turkish lira has lost nearly 1/3 of its value against the US dollar in 2018. Nice quick application. 2, the central bank may therefore wish to revalue their currency and then you now explain how they do it. And we did it a second ago. Remember to draw a supply and demand diagram. In this case, you're going to shift demand out. Therefore, are they buying or selling lira? They're going to be buying lira and therefore selling foreign reserves. You literally just say that. You go to revalue the currency, the central bank would buy Turkish lira and sell foreign reserves in the foreign exchange market. You now draw it, demand shifts out. As a result, the currency revalues. Finito, 5 marks. Yeah. The data, by the way, the diagram actually counts as application here as well. So that's very, very useful to draw, even though it's a 5 marker. Easy? Right. Then it has the following. Examine 2 reasons why the Turkish government may want to avoid a significant fall in the exchange rate of the Turkish lira. Right. What do they mean by significant fall? Obviously, they mean depreciation. There are 2 really good points here that I think work really well. One of which is actually, again, data-driven. So it says in the data that Turkey is highly indebted in foreign currency. Okay, can I just unshare this for a second and share my board instead to clarify this? So it says that they are highly indebted in foreign currency. And a lot of developing countries, by the way, are. A lot of international debt is quoted in US dollars, for example, to like the World Bank and the IMF, etc. Okay? I know this is, in fact, let's do it as lira. So let's say, imagine that 1 lira, initially, just to make our life a lot easier, I know obviously this is not true at all, is equal to 1 US dollar, okay? And let's say that they owe $100 million worth of debt. Now, if the lira suddenly depreciates, it suddenly sharply falls in value, so that 1 lira is now equal to 50 cents. Do you agree that their debt load has just doubled in real value? They now have to convert double the amount of lira to pay off that 100 million pounds of debt. This is a humongous problem for developing economies, by the way, and hence why the Harrod-Domar model talks about the foreign exchange gap being an issue, because their currencies tend to be weak. So when the CD was plunging in the previous question for Ghana, it meant the real value of their debt was going up. That is a big problem because they have to convert more and more of it to be able to pay that debt off. Whereas if they had foreign reserves, if you had loads of dollars in your economy, it's not a big deal that your currency is weaker compared to the dollar because you could just use the dollars in your economy to pay off the debts. Cool? Right, so that's our first problem, is the fact that the real value of debt is going to go up. The second problem is this, is that if your currency is really weak, do you agree that your imports are now a lot more expensive? Because again, I need to convert more lira to be able to buy goods and services from abroad. One of the assumptions, which is always valid, is that firms, whichever economy you're dealing with, will import a certain amount of their raw materials. It will always happen, yeah? Therefore, are the costs of production for those firms going up or down? Well, clearly they're going up because their imports are more expensive, so it's harder for them to import, or more expensive for them to import their raw materials. What can I draw now from theme 2? Well, I can draw a very basic diagram, which is the following. Real GDP here, or real output, same thing. Price level over here, and I draw this. SRAS, right? Can I just quickly clarify when you would draw SRAS and when you draw LRAS? Most of the time, you guys will be drawing LRAS, and you'll be drawing the Keynesian LRAS curve, yeah? SRAS is basically immediate cost factors. Things that straight away impact the costs of production for firms will cause SRAS to shift. That's when you would draw it. For example, the price of oil going up or down, SRAS. If wages go up or down, SRAS. In this case, raw materials are going to become more expensive because my imports are more expensive. My currency depreciates, so therefore it's more expensive for me to import. Well, SRAS in this case would shift inwards. And the consequences of that is not only negative growth, which is in itself a problem, but a specific type of inflation called, as I'm sure you know, cost push inflation. Cool? Right. In the context of the Turkey question, by the way, that was a really good point to make, because if you look at the data, I'll show you guys really quickly, the very first sentence was this. At an annual rate of 25%, Turkey's inflation is alarming. Oh, hello, application. Thank you very much, right? I spoke about this in the first session for paper 1, and I really hope that on Thursday, when you sat the exam, you guys followed my advice and didn't fall into the trap of writing too much for the 8 marker, yeah? The 8 marker is not a subjective question. The 8 marker is literally 3 sentences per paragraph to get you the analysis. Can I give you guys an example just out loud of how you pick up 8 out of 8 in this question like that? First thing I would do is this. One reason why, so I'd use their wording, one reason why the Turkish government may want to avoid a significant fall in the exchange rate of the Turkish lira, or a significant depreciation, you can kind of shorten it a little bit, is because it would increase the real value of their debt. It's my topic sentence. Yeah, that's one mark, knowledge, immediately. I straight away now need application. According to extract A, open quote, Turkey is highly indebted in foreign currency. Beautiful. That's close quote. That's my second mark. That's my application mark. Third is the analysis mark. I want you to try and explain it in as few sentences as possible. Obviously make it so that it makes sense, but you want to try and do it as quickly as possible. So what you write is this, is that when the lira depreciates, they would need to convert more and more lira to be able to buy $1, and therefore it is harder for them to service their debts, or the real value of their debt increases, making it harder for them to service debt. Service debts, by the way, is a fancy way of saying pay off their debts, yeah? 3 marks. That's my first analysis. I want you guys to leave a line now and do a second analysis. Don't do the evaluation of the marker until at the end. And it should be like 2 lines. Second analysis is another reason why the central bank, or I think there's a government here, may want to avoid a significant depreciation of the lira, is to avoid further inflation. Okay, open quote, at an annual rate of 25%, Turkey's inflation is alarming, close quote. Then you basically say that a depreciation of the lira makes imports more expensive, and thus the costs of production for Turkish firms are likely to rise. As a result, SRIS is likely to shift inwards, leading to even further inflation, as there would be cost push inflation. You don't even need to draw the diagram here. It's an 8 marker. Yeah, I mean, you have time. You probably could draw it really quickly, but I don't need you to. You've picked up the 6 analysis marks. That's it. You're done. All I need now is to pick up the 2 evaluation marks. The evaluation marks, by the way, so like you could talk about things like, oh, it might be temporary. There might be other things that happen in the economy that actually rectify this. Evaluations for an 8 marker are so lame. Like they're proper, like basic stuff, right? As an example, before I tell you the evaluation for this one, actually, can I show you the June 2017 paper? Just as an example of like lame evaluation for an 8 marker, but it works. The 8 marker here was about, with reference to figures 4 and 5 and your own knowledge, examine the relationship between national debt as a proportion of GDP and the fiscal deficit, right? If I have time, I actually might do this question later, but can I just show you the evaluation? Yeah. So you explain it, talk about the relationship between the two. And if you look at the figure, it has this, it has forecast. Go, oh, the data might be wrong. The forecast might be inaccurate. It may not actually transpire, right? In the same way in paper 1, June 2018, it was about how the PED for like electricity changed from minus 0.35 to minus 0.85. You go, the data might be wrong. It may not actually happen, right? By the way, you are never doing that evaluation for anything but an 8 marker, like a 10 marker, 12 marker, 15, no way. For an 8 marker though, I want to get those 2 marks as quickly as possible in as few sentences as possible. So that's an example of like what I refer to as like lame evaluation. In this context, I think that there is a good evaluation. You know, when you write this, I prefer you guys to try and use a very basic word to show the examiner that you are evaluating. And that word is however. But look out for the word however, because the word however is also used in the data to give you hints that there are evaluations. Here is your first however. However, it may have peaked. In other words, maybe they don't need to be that concerned because maybe inflation is as high as it's going to go. We're all good. And also later on, it says the lira has stabilized. Cool, right? Don't worry about it. It's stabilized. It's all good, right? The evaluation is then, however, according to the extract, the inflation rate may have peaked and the lira has stabilized. As such, the central bank or the government may not need to intervene and may not need to be concerned about the lira at this moment in time. Lame, I know, right? But it's 2 marks. Easy peasy. Cool? Right, let's go. That is the first part of exchange rates and dealing with exchange rates, whether it's them intervening or not. Very quickly, I want to show you how to answer a question as a 12 marker. Could be a 15 marker as well. I'd love it to be a 15 marker. Here. Assess the likely effects of the fall in the external value of the CD on Ghana's economy. Notice how many times they use so many different words. So here, external value of the CD. Over here, they had it as, what was it? A significant fall in the exchange. They tried to basically use words in a way to try to throw you off, to make your life a bit harder than it needs to be, yeah? Don't fall for it. Just read what that basically says and figure out logically what that means. Obviously, it means it depreciated, yeah? What is the consequences of a depreciation? Importantly, by the way, this particular question says on Ghana's economy, which is nice because it opens up more chains of reasoning and further depth than if it said, like in June 2013, let's very quickly show you guys. I promise I'll stop hopping around between papers like a crazed Edexcel fanatic. But June 2013 has a question about Brazil. Just want to flag up a slight difference between the 2 questions. The Brazil one is a 10 marker. and it's worded slightly differently. So the second extract is about Brazil. Here we go. It has this. Examine the likely effects of the appreciation of the real, Brazil's currency, on its balance of payments accounts. Okay. Notice that this does not say on the Brazilian economy. You are therefore limited to talking about basically exports and imports of the balance of payments here. Yeah. But it is a 10 marker, so it'd have one detailed analysis where you basically talk about the impact on exports, the impact on imports. That's it. That's your analysis. Yeah. But you don't bring in anything beyond that. Whereas the one that we're going to do is going to have a lot more depth because we're going to do the impact on the Ghanaian economy at large. Yeah. Analysis number one. Let's go. Whenever you get a question about the exchange rate, appreciating, depreciating, revaluing, or devaluing, you are to ask yourself a very simple question. Does that make the economy more or less price competitive? When I say price competitive, by the way, I mean cheaper. For others around the world, so for example, why do people buy a lot of products from China? Because China produce things at a very low cost. They are therefore price competitive. They're cheap. Whereas people buy goods from Germany because they are quality competitive. So if you think of competitiveness in terms of price and quality, it makes your life so much easier. So you go, okay, if the Ghanaian currency, the CD, has depreciated, are they more or less price competitive? Well, the answer very clearly is more price competitive. We're now in hopefully rolling easily from here. We go, they are more price competitive. Therefore, what's likely to happen to their exports? Exports are likely to rise. Now, in the exam, I want you to hear my voice screaming at you for a 12, a 15 marker, a 25 marker in particular, with a very basic question that will allow you to develop your points in enough detail to get into the top bands of analysis and evaluation. And that simple question is, why? Why? We just said exports go up. It's very tempting to just go exports up, imports down, but go exports are up. Why? And the reason why is because other currencies such as the US dollar can now buy more CD. At the same time, imports are likely to go down. Why? Because the Ghanaian currency, the CD, cannot buy as much in the global markets. The combination of rising exports and falling imports helps to reduce Ghana's current account deficit. And here's some data for you, which according to figure 3 is approximately, figure 2, my bad. Figure 2 is approximately 12.3% of their GDP as of 2014. It's analysis 1. This is one of those questions where I think it makes a lot more logical sense. So now leave a line and do the second analysis before the evaluations. Second analysis now, after I've talked about that, links very nicely to the first. So the first was about the balance of payments is getting better, right? X minus M. X minus M is a component of AD. And therefore, an increase in exports and a falling imports is likely to shift AD outwards. Exports are also a injection into the circular flow of income. And so there will be a positive multiplier effect. Bonus question, by the way, or bonus like a chain of reasoning here. In a developing country like Ghana, do you think the multiplier is likely to be big or small? Remember earlier I said to you guys, the bigger the marginal propensity to consume, the bigger the multiplier. The multiplier is going to be massive in a developing country because they have a very high marginal propensity to consume because they spend most of their income on basic necessities. So you go, the multiplier is going to be big. You then draw aggregate demand and aggregate supply, Keynesian LRAS, shift out your AD curve 2 times, summarize it, give me economic growth, talk to me about unemployment maybe going down, and enjoy your 8 marks of analysis. Easy peasy. Let's evaluate. And in order to evaluate, I need to draw something on my board. There are certain, macro is one of those things where the mark scheme has so many different points that you could use for a variety of different questions, yeah? And in most questions, I don't mind you guys using a selection of different points. This is not one of those questions. If you get a question on Monday about a depreciation, an appreciation, a devaluation, or a revaluation, and it's asking about the effects of that, whether it's on the balance of payments or on the economy at large, I obligate you to evaluate with something called the Marshall-Lerner condition. I need you guys to understand this. You basically will write the following. You go, however, for there to be, and then in this case, we said, an improvement in Ghana's current accounts following the depreciation of the CD, the Marshall-Lerner condition must be satisfied. You need to memorize this. The Marshall-Lerner condition states, or the condition states that the average sum of the price elasticities of imports and exports must be greater than 1. It needs to be elastic, basically. And the logic is this. So imagine I told you guys, in terms of like analysis that we just did, especially what you were doing this in theme 2, it's like almost like very babyish, where you go, you're more price competitive because your currency's got weaker. Therefore, you export more, you import less. Yay. your current account's better, amazing, right? But do you know what that ignores? That totally ignores the value of the good and how many units you're selling. So what I mean by that is this. Okay, let's break it up between exports and imports. Imagine that collectively we sell, I don't know, bottles of water for a living, yeah? And I'm like to you guys, okay, we've decided to reduce the price of the bottles of water, yeah? So let's say we used to sell it for £1 and now we sell it for 90p. Yeah, I don't know why there's an arrow there. We now reduce it to 90 pence, yeah? Okay, logically, what will happen to our sales? Obviously, our sales are going to go up. Do we agree with that? Like, obviously, we're going to get more sales just because of the fact that we're offering something at a lower price. However, is that enough information for you to tell me whether we ended up making more or less money? No, because what you need to know is how much did our sales go up by? Because in the example over here, so let's say initially I sold 100 bottles for £100, for £1, yeah? So therefore, I was earning 100 quid here, yeah? Now imagine I've decreased the price by 10%. But let's just say, imagine that the number of units that we sell now only goes up by 1%. It goes up to 101. Right, let's do the maths together. What does that mean? Because it went up, right? We basically sold more bottles of water, because that's exactly what we just said. 101 times 0.9, I should probably be able to do this in my head. I don't know why I didn't use calculator, but is £90 and 90 pence. Did we end up making more money or less money? We ended up making less money. And you know, when it comes to an exchange rate and a depreciation, that is exactly the same thing. When I talked about how I'm selling goods for a cheaper amount, it is that. Your pound is weaker in the global market. So of course you'll sell more. That's inevitable. However, if you only sell a tiny bit more, if your demand only goes up a little bit, in other words, if it's inelastic, then the consequences of that is that you end up earning less money. Your export earnings go down, not up. The same thing is true on the import side of things, by the way. Of course, I'll import less if everything is now more expensive compared to before. However, if I only import a tiny bit less because my demand for imports may be inelastic, do you agree that in that scenario, I'm paying more for my imports than I used to pay? This evaluation is phenomenal. I need you guys to understand this is always going to be the mark scheme and that it is top level. You basically say that the condition states this, and then after that you say this is because every unit that Ghana exports is now cheaper, whilst every unit they import is now more expensive. Yeah. So that will be the first part of the evaluation. What I always want you to link together with the Marshall learning condition straight away, almost pretend that they're like one evaluation, even though technically it's two, is you're now going to draw the J curve. Yeah. So let's draw the J curve. Right. This is how the J curve works. So we're going to have time on the x-axis, and then we've got the current account on the y-axis, where this is positive and this is negative. Okay, where you start, basically, whether it's here or here, depends on the country in question. Most countries are likely to be in a deficit. And obviously we know that from the extract that Ghana definitely are in a deficit. If you're not sure, probably start in the deficit, but it usually will tell you. So like an example of a country that would be here is China, Germany, Japan, yeah, countries that export, that are net exporters. But here we're over here, right. So what I want you to start with is imagine nothing has happened yet. So you're just going to draw a line like this, where absolutely nothing has occurred yet, yeah? And then the way to figure out how to draw this particular curve is to say to yourself, whatever I have just said happens in the analysis, the opposite happens first. So you know how in the analysis, we just said the current account is going to shrink, the deficit is going to get better, it's going to shrink. Well, the opposite of that is going to happen first. The deficit is going to get bigger first. It's going to go down, and then it eventually will get better. And that point there, by the way, is the exact moment in time where the depreciation happens. So you can go depreciation of, in this case, it was CD. Cool? And how do we explain this? Well, this basically is the following. It says, in the short run, firms are, in the short run, so you go, the J curve illustrates that in the short run, the Ghanaian current account deficit is actually likely to worsen. This is because firms are tied into trade contracts and consumers tend to exhibit habitual behavior. If you're in a trade contract, in other words, you have a set amount that you agree that you sell each month, you export, and you buy a certain amount, you import a certain amount. Do you agree that you can't readjust that contract very quickly? And therefore, is the Marshall learner condition likely to be satisfied? Are your exports and imports likely to be elastic or inelastic? Clearly inelastic. Therefore, this is why the current account initially gets worse. The Marshall learning condition isn't satisfied. So you go, in the short run, firms are tied into trade contracts and consumers exhibit habitual behavior. Therefore, the Marshall learning condition is not satisfied. And so the current account initially gets worse. In the long run, these trade contracts can be renegotiated, and provided that the Marshall learning condition is satisfied, the current account now starts to improve. Cool. That is exceptional evaluation, by the way. This in a 10 gets you all 4 evaluation marks, and in a 12, it will get you all 4 evaluation marks. Marshall Lerner and Jacob, yeah? But can I add one more thing, yeah? So let's assume this was a 15 marker rather than a 12. The analysis stays as it is, but the evaluation now, we're going to consider it to be 1. If you're running out of time though in an exam, you can move on from this. It will get you the most, if not all, the evaluation marks. But as a second evaluation, there is method to this madness. And the method to the madness is, why did I just show you the question about Turkey first? Because the 8 marker was about problems associated with a depreciation. These are your evaluations here. So one of the problems that we identified is the fact that it's harder for them to service international debt. They have to convert more lira, or in this case, more CD, to basically pay off their debt because their currency is weaker. The real value of their debt, therefore, is rising. An alternative is to say it's going to be more expensive for Ghanaian firms to import their raw materials. Their costs of production, therefore, go up. You could draw an SRAS diagram shifting in. Cost push inflation adds to the high levels of inflation that Ghana already have in their economy. Cool. That's exchange rates done. Let's go. Next topic, competitiveness. I think that there is, I've said that for everything. Honestly, like I said at the beginning of this course, this is not me trying to predict anything or trying to second guess what will come up. Be prepared for everything. I'm trying to cover as much as I can in the session that we have. And hopefully this is making sense. By the way, I can see loads of you within Zoom are asking me loads of questions. I promise I will try my best to have a look at them and read them. I have like loads of pre-prepared questions that people sent me in advance. So I'll try and get through those first. I know some of you really badly want me to go through the financial sector. I will, I promise. I will get to it in a second. The last thing I want to do before we get onto that is the competitiveness. That was it. Right. There's a question I want to show you. And there's a generic answer that I want you to know to be able to answer if they ask a 25 mark potentially on this. Unit 4, June 2012, I believe. Right, let's have a look. Right. I would, if I were you, do this data set. If you have time tomorrow, at least plan it. Because if I am correct, and I honestly genuinely may not be correct, and it's about things like the Eurozone, this is a pretty good thing to know about, yeah? The question I want to basically do is this: examine policies which might improve the competitiveness of goods and services produced by Greece, Italy, and Portugal. Okay. From now on, every single time you have a question about competitiveness, there are 2 things that I want you to remember. One is obviously what I said earlier, which is think of Germany and China as your kind of staple examples. China are price competitive because they are cheaper, and Germany are quality competitive because their goods are high quality. They've got really strong branding. They're like durable. They're good, right? Okay. If you just remember that, then this type of question becomes really easy, because all you have to basically do is find a way to make your goods cheaper or to make your goods better, like better quality. The second thing I want you to remember is if this gets asked as a 25 marker, as a 12 or a 15 marker, or even as a 10, convert this question to be the following: which supply side policies can a government use to improve its competitiveness? That is the route I always want you to take. It will make your life so much easier. You are guaranteed to have the marks if you're going to basically go down the route of supply side policies here, because supply side policies 100% effectively do this. The first supply side policy that I definitely want you to start with is investment into education training, 100%. So one policy that the Italian, Portuguese, and Greek governments could use, you can just say these governments could use, is to invest into education and training programs. There are a couple of key buzzwords when it comes to education and training that I ideally want you to talk about. The first is that it raises the level of human capital within the economy. Human capital is basically a fancy way of saying, imagine that the workers, consider them to be like machines. So if each worker is now more productive, do you agree the human capital level's gone up? The other thing that's really good to talk about is that it reduces unit labor costs. Unit labor cost is a fancy way of saying the cost per worker relative to the output that the worker produces. So in other words, how productive a worker is going to have a major bearing on its unit labor cost. Well, look at the data. Here we are. It has the following. Figure 4, unit labor costs in selected Eurozone countries. Notice that Greece, Italy, and Spain and Portugal are so far behind Germany, right? What does that mean? Does that mean that people in Italy get paid a higher salary than workers in Germany? No, not at all. German workers probably get paid a lot more than Italian workers. However, despite the higher wages being provided to German workers, they are so much more efficient than Italian, Greek, Spanish, and Portuguese workers that the cost per unit is lower, hence why unit labor costs are low in Germany. Well, if you invest into education and training programs, do you agree that your unit labor costs are likely to go down? Another benefit of investing into education and training programs is it can rectify issues like structural unemployment. You might get more workers working in the economy and doing skills that are needed in the economy to enable it to produce goods more efficiently. And so again, that makes you more price competitive. Yeah. The last thing that you could talk about in terms of education and training and how this basically can improve competitiveness is, do you agree that a more educated workforce is more capable of like technological breakthroughs and innovations? So therefore the quality of the goods may also go up. Nice, easy. Yeah. Easy diagram as well. So let me just quickly share this, is you can now draw this. I'm sure you all know how to do an outward shift of the LRAS curve. You do this, real GDP, price level. I'm going to do it really quickly, like PL, LRAS1. Right, when you're shifting out LRAS, make sure you have AD initially at either bottleneck or full capacity. So you show what we want it to show here. Y1, P1, and now LRAS2. Right, notice something. The increase in the productive capacity of the economy led to, what is that? That is disinflation. That is phenomenal for what we want because of the fact, right now, obviously inflation is really high. Disinflation makes us more price competitive. And of course, all the things we just said earlier in terms of innovation and workers and how amazing they are also makes us more quality competitive. Now, bear in mind, you don't need to speak about both, nor do you have to speak about both in the same paragraph. I could have split up, but like it made sense to talk about them here, yeah? So education and training is definitely our first analysis. The go-to evaluation when it comes to education training all the time is that there's a massive timeline. That it's going to take a long time for people to actually pass through the education system and begin impacting the economy in a meaningful way. There's a danger that by the time individuals actually get through the education system and come out of the other side, certain skills may have become outdated. This is very relevant right now, by the way, with AI. AI is moving at such a rapid speed that a lot of jobs are basically at risk. A lot of things that people are currently doing and they've been doing for 10, 15, 20, 30 years of their life may suddenly become outdated and obsolete because of technological advancements and AI. So that's a problem with education and training, yeah? One analysis, one evaluation. Right, let's do a second analysis. The second analysis now might be dependent on the data, but obviously there are some generic ones that work. Any supply side policies work here. I think the one that I would do is reduce corporation tax. So number 2, reduce corporation tax. Right, that is terrible handwriting. I'm sorry. Let me write it in a way that's coherent for you guys. So reduce corporation tax. Okay, what is corporation tax? Well, corporation tax is a tax on a firm's profits. And then you now link it back to the fact that if they have less, if they have to pay less in tax, firms within the country, do you agree that that translates into them having more profits? What can they do with the higher profits? Well, they can invest into the latest technology, into R&D. They're more likely to be innovative, etc., etc. If you find that this is a bigger question, the way you could develop that in even more detail is to say low corporation tax may also attract FDI. And TNCs that come into your economy, there are 2 benefits. One, in terms of competitiveness. One is they tend to import over their technology to your country. So that's already going to make you more competitive. But 2 is that sometimes TNCs, when they set up in a country, especially a developing country, by the way, it is often in their interest to improve the infrastructure of the economy. It might be easier for them to invest into like an airport or like a road to make it be easier for them to get like logistics and things that they need transported over, right? So let's say they improve the roads, but that doesn't just benefit them. Do you agree it's going to benefit multiple firms within the economy? And therefore there are going to be what we call external economies of scale, as you know from theme 3, yeah? All of that benefits the economy and makes it more efficient, more productive, and therefore more quality and price competitive. Easy. By the way, notice that the thing that you should not do for this question is you should not then develop it by talking about exports and imports, like the impact of it. It's just asking, how do you improve competitiveness? It is not, what is the consequence of becoming more competitive? If it were, I'd be down the road of basically exports and imports and then AD shifting out, all of that fun stuff. But if the question is just about how to become more competitive or causes of competitiveness going up or down, you're only talking about what I've just described over here. Yeah? Right, the evaluation to reduce corporation tax is really straightforward. You can basically talk about how actually it depends. Firms may not necessarily invest the additional profits into R&D. They might instead pay out more dividends to their shareholders. There's that. Number 2 is it depends on the state of the economy. So for example, right now in the UK, business confidence is likely to be fairly low for 2 reasons. One is they're still kind of recovering from the aftermath of COVID. And 2 is because of the fact that the UK has left the EU. So therefore, there's loads of like barriers, there's more regulation, there's more restrictions in terms of how they trade. So they might not necessarily be willing to invest right now. They might be like a bit reluctant to invest. Is that clear? I hope that makes sense, yeah? Right, I'm going to quickly have a look. at some of your questions. Sorry. So can you do a second point as the evaluation of currency to increase? Oh, good question. Right. Someone just asked, could you do the devaluation of the currency as a means of increasing competitiveness? Yes, but be very, very careful. The reason why you need to be careful in the context of the question I showed you guys, so let me show you the question again. Why can you not do that here? The reason why you cannot do that here is because Greece, Italy, and Portugal are part of the Eurozone. It is not up to them to devalue the currency. They are part of a trading bloc and a monetary union specifically. If it were about a country outside of a bloc, yes, you could do that. And you could explain the mechanism by which they basically achieve it as kind of the explanation of how they become more price competitive. So yes, for sure. Yeah. So good question. Can you talk about dynamic efficiency with reducing corporation tax, or is that too micro? Okay, right. I get this a lot. I get questions about, oh, I'm really scared. Like I'm making micro points and it's a macro paper. Guys, it overlaps. There's a major overlap between micro and macro, and you're very welcome to talk about micro as long as you don't go too micro. So if you're going to talk about, for example, like the impact of external economies of scale, I'm not going to draw the AC curve, right? But I definitely will reference it. The whole premise of, for example, the infant industry argument in protectionism is entirely micro. It is all about economies of scale. If there is a micro thing that isn't just in passing, of course, you should basically talk about it. Yeah, like, of course, you should basically throw it in. Yeah, right. Okay, right. Let's have a look at, I promise to read a few more of your points as soon as I can. I have quite a few things that I want to quickly go through. One of the topics I think is absolutely imperative that we talk about, because I think it could be a 25 marker, or it could be, it could be anything. Anything could be anything. I don't know why I keep saying I think, I don't know. Right, anyways, so it's economic development. Let's deal with economic development. And I need you guys to have an understanding of economic development. And I think there are 3 potential type of questions that can come up as a 25 marker for economic development that I want to make sure we basically deal with, yeah? So starting point is this. What is the difference between economic growth and economic development? Because you do need to know that. If I ever get a question about economic development, I would always start in my introduction by defining both growth and development. Even if the question is just about economic development, it's a very good idea to do it. Well, economic growth is a rise in real GDP. Yeah. So economic growth is an increase in real GDP. Economic development tries to go one step further. So what economic development is it also takes into account non-monetary factors such as education, healthcare, infrastructure. Always reference that. So you go, economic development tries to take into account, non-monetary factors. By the way, it does still take into account GNI, which is a measure of economic growth, and GDP as well, by the way. But it's not just that, it's more than that. It takes into account things like education, healthcare, and infrastructure. And the thing that I think will allow you to always satisfy the condition of answering the question about it being about development is always link it back to HDI. You guys need to know about HDI in terms of potentially section A, maybe even a section B question. Know that it's made up of 3 components: living standards, GNI per capita at PPP rates. It's made up of healthcare. I can't remember the exact what the metric is for healthcare, things like life expectancy of birth, maybe, but don't quote me on that. And then there's education. So those are the 3 strands of HDI. Yeah. Okay. Let's deal with the following question first. Question number 1 that I want us to write down in your notes, please, is as follows: evaluate the main constraints that continue to limit economic development in a developing country of your choice. Okay, so imagine this is a 25 marker. It says evaluate constraints that continue to limit growth and development, or development, in a country of your choice. Now, it's obviously a good idea to have a country in mind to reference in a 25 marker. On our Instagram page, we've created a little kind of infographic for you guys about the UK for developed economy, and then for the Ivory Coast for a developing country. If you have a country in mind that you know more stats about, great. You don't need to know too much, by the way. Yeah, like you can be very strategic about. So when I put together that little thing for the Ivory Coast, I was very selective about the things that I wanted it to mention, because in my mind, I know the type of question that realistically I'm going to be using it for. Yeah. Okay. There are obviously a multitude of different limitations to growth and development. You could potentially have, by the way, a question very specific about one, less likely to be a 25, never know. But in the data response, they can definitely kind of identify either a strategy or a limitation and expect you to know it. So for the purposes of this session, I obviously can't go through every single limitation and every single strategy towards economic development. But it's a really good idea for you guys to make sure that you are prepared for those eventualities and understand the differences between the different types, yeah? The ones that I want to do for this question, without a shadow of a doubt, number 1 is primary product dependency. Let's deal with that. Primary product dependency. Right. Many developing countries suffer from this. A primary product, as a starting point, what is a primary product? A primary product is basically something that is sourced from the earth. It is also known as a commodity, in case you read that in a data response, yeah? And the issue with primary products is that if I look at the price of a primary product over time, so if I have, you'll never draw this, by the way, this is just for illustrative purposes. The price of a commodity over time, it typically does this. It is extremely volatile, where prices go up and down rapidly. Why? Because of the fact that there are certain things as a farmer or a producer that are out of your control, especially the weather. So you might have a good harvest, you might have a bad harvest, and therefore it is very difficult for you to plan ahead. Okay, what I would now basically do is I'd basically say, look, a country such as the Ivory Coast are heavily reliant on the export and sale of primary products such as cocoa. If I remember off the top of my head, I mean, I might be getting these numbers wrong, check on our Instagram page. I think something like 45% of their export earnings or export revenue is from the sale of cocoa. They definitely sell loads of cocoa, yeah? So whatever that number is, you quote that. And I think it said 65% of the population work within the agricultural sector. Basically, the vast majority of people within the Ivory Coast economy work in the agricultural sector. So then, okay, let's go through two scenarios. Scenario number one is, let's say the price of cocoa absolutely free falls. It's somewhere down there. Do you agree that logically, that means that many of the farmers are likely to be shutting down? Do you agree that their earnings are so low that they're basically falling potentially into absolute poverty? Do you agree that the government are likely to generate way less tax revenue? That their current account is likely to get a lot worse because of the fact that their export earnings are going to dramatically fall, etc., etc., etc. Yeah. Now, some of you might be saying to me, "Oh, what if the price of commodities go down? Isn't that good though? Because then they can sell loads more because demand will go up." Yeah, it will. But think about it. Do you think the PED for a primary product, a commodity, is likely to be elastic or inelastic? The answer is inelastic, because you don't imagine, for example, I said to you, the price of food has gone down. Are you going to go and consume significantly more food? Well, obviously not. In the same way that if the price of food goes up, you won't starve yourself. Your demand will only go down a little bit. So even when the price is really low, there is not going to be a dramatic increase in demand for the cocoa. So they're not going to get that. They're going to get less revenue than they got before. Yeah. Right. So that's the first kind of scenario, which is really bad. If prices are really low, you're going to end up basically all of these problems. But the other problem is this: is that when the price is really high, like all the way up there. So let's say that was caused by demand factors. Let's say all around the world, more people want to buy cocoa. The problem, though, is that the manufacturers, well, not necessarily the manufacturers, it's a terrible word, the farmers within the Ivory Coast, can they significantly scale up their production of cocoa? The answer is a definitive no, because the PES is likely to be less than 1. It is very, very inelastic. Why? Because it takes approximately 5 years to get a cocoa tree to fully harvest. Again, this is an infographic. I think it says 3 to 7 years. On average, about 5 years. Yeah. Therefore, even if the price of cocoa is really high, can you actually make that much more money as a farmer in the Ivory Coast? The answer is, again, no. This is therefore a problem. That's the first part of prime product dependency. That's an issue. Within that paragraph, if it was a 25 marker, do you know what else I would talk about? I would talk about the volatility of these prices. Does it make it easy or difficult for you to therefore plan ahead? Do you agree it is really difficult for you to plan ahead with any conviction and certainty? Therefore, investment into these economies is likely to be low. And when investment is low, economic development is also likely to be low because they're falling behind. The technology is not as advanced. That's your first analysis. Cool? Let's evaluate that. The evaluation that I want you to do, there are loads of evaluations here. So as an example, you could reference the fact that there are some countries that have done really well selling primary products. Botswana have sold diamonds and thrived. Chile sell copper and they've done very well. The United Arab Emirates sell oil and they've done really well through that, right? The example, the other alternative though, is I think this one works better, is to say, look, one of the ways that this is not as big an issue as it used to be is now we bring in the financial sector and go, they could take advantage of forward markets. What is a forward market? A forward market is where you as a producer in advance agree to sell your commodity for a fixed price and you are guaranteed to receive that price at that date, regardless of what the market price is at that time. If I'm selling cocoa and I agree, let's say 6 months in advance to sell my cocoa for $3, it does not matter what the market price is, I'm going to get $3. If the market price plummets so that it is now only worth $1, no problem for me because I'm guaranteed to get my $3. Obviously, there's an element of risk as well here because the price could have actually gone up to, let's say, £5, let's say $5, right? But even then, it's still fine because yes, I could have made more, but truthfully, I can now plan with a lot more conviction around this particular price. Therefore, forward markets are a great way to mitigate the risk involved with primary products. And therefore, it would allow these farmers and producers to plan ahead with more conviction. Therefore, the level of investment might actually go up. That is a great evaluation here, by the way. Yeah. Just before I finish this essay, by the way, I think that if you get a 12 marker on primary product dependency, your second analysis needs to be the Prebisch-Singer hypothesis, which is a fairly sophisticated theory, but let me explain very quickly. In a nutshell, the Prebisch-Singer hypothesis is this. Bear in mind, this is being recorded, so you guys can watch it back later. And I highly recommend you actually memorize what I'm about to dictate word for word. Just listen to it now, because I'll do it too fast for you to keep up and be able to write it. But in a nutshell, this is what it's going to say. So let me actually write out Prebisch-Singer as in the name. So Prebisch-Singer. Okay. Right, and I'm going to draw a diagram to illustrate this for you guys, just to make your life easier to understand. You'll never ever draw this diagram, by the way. This is just illustrative, but I will show you guys in a sec. Demand. Okay, right, I'll do this in a sec. Right, watch this. The Prebisch-Singer hypothesis states that a country that exports primary products will be able to import less and less for any given level of exports over time. This is because the YED, so income elasticity of demand, for manufactured goods is greater than that of primary products, especially food, such as cocoa, by the way, yeah? As such, when global incomes rise, the demand for manufactured goods will rise more than that of primary products, and thus the relative price of manufactured goods will be higher. Given this, countries that export primary products will experience a deterioration in their terms of trade. Right, I know I went really fast. Let me just clarify very quickly what that means. In a nutshell, countries that are going to export commodities are going to experience a decline, a deterioration in their terms of trade. Before I go through that, then what are terms of trade? Terms of trade is the price index of exports divided by, so I'm trying to squeeze it in right at the top. Why am I trying to squeeze it in? Let's do it here. So we're going to do price index of exports, so X, over the price index of M, and you times that by 100. Okay. In other words, I'm looking purely at the monetary value of my exports relative to the monetary value of my imports. It is not about how much I'm selling or buying, by the way. A common misconception is people mix that up. So if I said to you hypothetically that inflation is high in the UK, right? What would happen to the UK's terms of trade? A lot of you are telling me, probably telling me right now, it's going to get worse. And in your mind, you go, because if inflation is high, you're less price competitive, so exports will go down and imports will go up. But no, because that's in terms of quantities, so that's completely wrong. What you should have done is this. You go, if inflation is high in the UK, British goods in terms of price are going up, exports up. Top of the fraction going up, the overall number is therefore going up. The terms of trade actually improve when you have inflation. I'm not saying that's a good thing, by the way, but I need you to understand how terms of trade work, and then I'll show you why it's relevant for a developing economy. Right. The theory basically can be summarized in the first sentence of what I described in the Prebisch-Singer hypothesis, which says that a country that exports a commodity, a primary product, will be able to import less and less for any given level of exports over time. So what they sell to the world will allow them to buy less over time. The logic is this, the YED. So what is YED? YED, as you know, definitely from paper one, is percentage change of quantity demanded over the percentage change in income, right? Well, one of the things I can determine through YED is whether goods are normal or inferior, right? Let's assume that both primary products and manufactured goods are normal goods here, yeah? Do you agree the YED for manufactured goods is far more elastic than the YED for commodities, especially food? Because if your income doubles tomorrow, are you going to double the amount of food that you eat? Are you going to lose your mind and start like just going crazy, right? Like eat like 3 burgers, right? It's very worrying that I start doing 3 and not 2. But anyways, right? It's basically not going to happen that you're going to dramatically increase your demand for food. You might demand a little bit more. You might probably switch to like higher quality food, right? I don't know. You start buying some Tesco Value to Tesco Finest. Treat yourself, right? So there's that. Whereas the demand for manufactured goods is far more elastic in terms of YED. Think about it in terms of like TVs in your house, right? Hypothetically, let's say there was one TV in your house, yeah? And let's say your income now goes up by 20%. 20% right increase in your salary. Good for you, right? But then you buy a second TV for the house, right? The mathematicians amongst us, hopefully, you are very quickly able to figure out what the percentage change is in the demand for TVs there. It has doubled, meaning that's a 100% increase in the quantity demanded. In other words, if I plug that into my formula, do you agree that it's extremely elastic? Yeah, it was very reactive relative to the change in my income. Okay, why is this a problem for countries that are exporting commodities and importing manufactured goods? Because if I now do the following, let's make our life nice and easy and go, okay, imagine this is the Ivory Coast and this is, let's say, Germany. Okay. Just to make our life easier, I know this is highly unrealistic, but let's pretend that this is the price of cocoa and this is the price of, let's say, I don't know, a manufactured goods that Germany is producing, whatever that might be. Yeah. Initially, if the Ivory Coast were to sell 1 unit in the global market, how many units would they now be able to buy with their money from Germany? Do you agree they could buy 1 unit because it's the same price? So I did it so that it's not a trick question, nice and easy. Okay. Now, global incomes over time are always rising. It's very rare for global incomes to go down. The exceptions are like the Great Depression of 1930s. Really quickly, while I'm on that, I got one of the emails is how much do I need to know? Absolutely nothing. Yeah, you will not get a question about the Great Depression. It says it in the specification. The only thing you need to understand is the impact of expansionary monetary and fiscal policies. So just that, yeah, which we will hopefully deal with if we have time later. But don't worry, you don't need to know like the history of the Great Depression. The 2008 financial crash is another time where basically global incomes went down. But other than that, global incomes are pretty much always going up. Now, when that happens, do you agree? We said that the demand for the Ivory Coast for their primary products will go up. So therefore, I can show that by a little shift in demand because it was inelastic. There's not going to be a dramatic increase in demand, but there'll be a little bit of an increase. So good for the Ivory Coast because look, the price they now charge has gone up. The issue, though, is that we said the demand for manufactured goods that Germany produce are far more elastic. Hence, a smaller increase or an increase in the income results in a more than proportionate increase in demand. Demand for Germany then does this. And now I ask my same question again. You know how before I said that when Ivory Coast sell 1 unit to the world, they were able to buy 1 unit from Germany. Is that still the case? The answer clearly is no. Now, if they sell 1 unit, they cannot buy 1 German good. They have to convert more or sell more of their product to buy 1 unit from Germany. Hence, their terms of trade are worsening. Because if you look at that formula, the price of their exports goes up, but the price of their imports goes up even quicker. Hence, the overall number is deteriorating, it's falling. Now, why is this an issue? The reason why this is an issue is in the first instance, individuals in the Ivory Coast now have lower living standards. It's harder for them to import things from abroad, so they're restricted to buying things domestically, which may not be as good. But number 2 is it's hard for firms that want to develop in the sector, like the manufacturing sector in Ivory Coast, to import the capital machinery required and the technology required to develop that sector. They therefore become even more primary product dependent. Is that clear? So the idea is that, look, your terms of trade declining in a developing country is a pretty bad thing because it needs now you to sell more of your good to be able to import. The terms of trade are deteriorating, and that is a problemo. That is the second analysis, by the way, if the question was just on primary product dependency, which is a lovely question. June 2013 has a 12 marker, by the way, for you to do in the Brazil question. You do that in your own time, yeah? Anyways, right. In terms of an evaluation here, by the way, I think a very good evaluation generically for primary product dependency is to say, look, however, these countries tend to have a comparative advantage in the production of primary products. And economic theory would argue that they should be specializing in those commodities, therefore doing the right thing. Why, by the way, would the Ivory Coast have a comparative advantage in the production of cocoa? Well, because of the fact that they have the right climate to grow cocoa. They have the exact right climate, and therefore they can produce it at much higher scale and much more efficiently than any other country in the world. Hence why they are the biggest exporter of and producer of cocoa in the whole world. Cool? Right, let's go back to our essay. The first half of the essay was primary product dependency, and we evaluated it with forward markets. Second analysis, if I got a question about constraints to economic growth, without a shadow of a doubt, is to talk about the Harrod-Domar model savings gap. Harrod-Domar, right, savings gap. Okay. Right, can I just go through what the savings gap is now? So, The Harrow-Domar model basically argues that one of the biggest reasons why developing countries struggle to grow and develop is due to a lack of savings in their economy. And the logic is very sound because it says, look, if you look at the GDP per capita within these countries, so GDP per capita, as I'm sure you hopefully all know, is basically, so GDP per capita is GDP over population, yeah? Okay. Well, the GDP per capita in these economies tends to be very, very low. They have very limited amounts of income. And therefore, they have a very high marginal propensity to consume because the vast majority of the very limited amount of money they earn is spent buying basic necessities. If I said to you that you only earn, let's say, $5 a day, do you agree that realistically you're going to spend practically all that $5 just to live on things like food, shelter, clothing, okay? Therefore, because they have a high MPC, their savings rate is very, very low. What's made worse or makes it worse is the financial sector is underdeveloped. So banks, think about how a bank makes money. When I put money in, let's say, Santander, right? Do Santander sit there waiting for me to come back? Is it like a vault that I just like put money in and like get money whenever I want? No. What Santander and other banks do is I'm basically lending money to them, by the way. When I'm saving, I'm basically lending them money. They lend it out to like businesses, to individuals. They invest it in like all sorts of things like bonds and whatever. And so the consequence of that is they try to grow the money, right? Okay, you're a bank then. Would you have the incentive to set up in a country where practically no one is saving? Obviously not. So the financial sector tends to be very underdeveloped in these economies. So even the individuals within the country that want to save, they don't really have a means to save. Imagine you had to walk 10 miles to get to a bank to put cash into the account. Would you do that on a regular basis? Obviously not. And therefore the savings gap is even bigger. Cool? Right, so that's the first starting point. But why are savings important? The reason why savings are important is because when you have banks, when they have money in their accounts, can lend money to firms. And that lending is specifically for investment. And investment is crucial for long-term economic growth and development. Because investment doesn't just cause the aggregate demand curve to shift outwards, i.e. component of AD, also an injection, all of that. It also causes the LRAS curve to shift outwards. It leads to higher levels of economic development because of the investment might mean that you invest into new capital, to new technology, all of these things that lead to economic development. Therefore, in a nutshell, we have the following. We go low savings leads to low investment, low capital accumulation, really fancy way, by the way, of saying the rate at which the capital stock increases in your economy, therefore low economic growth and development. That is a phenomenal paragraph by way of analysis, yeah? I would definitely do this as my second analysis if this was a 25 marker, yeah? Let's evaluate it. How do we evaluate this? Well, the evaluation to this is to talk about how this might not be as significant a problem as maybe it was 20 or 30 years ago. And there are two reasons why. So the overarching evaluation with this, however, the savings gap may not be as significant a limitation as it used to be or as it once was. This is for two main reasons. One, do you agree that a lot of countries, like the Ivory Coast, receive high levels of international aid? And aid can help to reduce, or what they call fill the savings gap. Why? Because if people are getting aid in the form of things like clothing and let's say food and shelter, or well, not shelter, like clothing and food, do you agree they don't need to spend as large a proportion of their income on these basic necessities now? And if they don't need to spend as large a proportion of their money on these basic necessities, do you agree it makes it easier for them to save? Therefore, the savings rate may start to go up. And if the savings rate starts to go up, banks might set up and all of that. Yeah. So it might not be as big an issue. Number two, that I think is very relevant to what's going on right now, is that there have been major advances in technology in the financial services sector. Yeah. So technology makes it much easier for you to save compared to, again, let's say 10 years ago, 15 years ago. Why? Because let's say I own a fruit stall in the Ivory Coast, yeah, and I'm selling fruit. If I just now buy a card reader, do you agree now, if I can take digital payments like card payments, I no longer need to lug around large sums of cash 10 miles to get to a bank and deposit cash, because as soon as someone pays by card, the bank transfers money from their bank account into my bank account. Therefore, I don't need to basically, the logistics of the operation are much, much more straightforward. Is that super duper clear? So that would be the evaluations for the savings gap. Hopefully that's really, really clear. Right. Cool. That's the limitations to growth and development. I will do strategies to promote growth and development in a second. Sorry, my eyes are really watery. But before that, I actually want to take you guys through what I regard as probably one of the hardest questions they have set so far in your specification, which combines the financial sector with economic development. Quite a few of you asked about this, so let's deal with this question. Right. Yes, here we go. Right, it is from the June 2018 paper 2. And I want to make sure you guys actually know how to answer this. So June 2018, paper 2 is as follows. Here we go. It says, discuss the role of the financial sector in the growth and development of developing countries. I honestly think this is the hardest 15 marker that has been set so far in the paper 2 exam up to now. Yeah, it combines two topics together, and the technique in terms of how to approach this question is a little bit more challenging than a normal 15 marker. Yeah, so if you capture that question down, please, into your notes, you can always come back, obviously, and do this. I just want to share my screen and talk to you about how you plan a question like this. Yeah, so what you need to do for this is, look, in my timings that I put out for you guys on Instagram, and I hope you followed it for paper 1, definitely follow it for paper 2. It should, if you stick to it, give you guys more time for the 15 marker and the 20 marker, because those questions need a bit of thinking. They need you to, especially like this. If you jump into an answer like this, it's probably going to go really badly wrong. So take a moment to just go, okay, what are the two things that I need to consider here? One of the things I need to consider here is what the role of the financial sector is. Another is economic development, be the limitations to growth and development or strategies to promote growth and development. So let me share my screen, and we're going to do a little exercise together. What I want us to do together is this. Let's list as many limitations to growth and development as we can think of. Well, we've already done 2 straight away. So number 1 is PPD, primary product dependency. Yeah. Number 2 is savings gap. Number 3 is foreign exchange gap. So these economies tend to have very low levels of foreign reserves. Number 4, other limitations to growth and development are things like corruption. There might be high levels of corruption within the economy. Number 5 is it could be that they have a civil war. Right, you get the gist. There are others as well, like 6 could be like low human capital. So the workers in the economy are low skilled, etc. So you get the gist. There's loads, right? There's like 8, 9. I'm not going to list all of them. Right, what I now do is I go, okay, these are the problems. Let me now think about what the role of the financial sector is. Now, the financial sector has 5 roles. You need to know these because you can easily get a question specifically about one of the roles. So the financial sector does the following. 1, facilitate savings. 2, facilitate lending. So banks are there to give loans out to either individuals or to businesses. Number 3, to facilitate exchange. So it's a lot easier to buy and sell goods and services when there's a financial sector that's operational. Number 4, to provide forward markets. We've spoken about this already. A forward market, by the way, so forward markets typically are provided in 2 areas. One is commodities, because they're really volatile. The other one is exchange rates, again, because they're really volatile. June 2019, paper 2, the 5 marker is about basically providing forward markets in the exchange rate market. Not a bad question to potentially look at and do. The last one is to provide a market for equities. Equities are basically stocks and shares in a company. So let's say, we can buy shares in Apple. If they make profit, we get dividends. Yeah. Right. Now that I've done that, look at how much easier, hopefully, this question is starting to look. Because what I now do is I go, which of these limitations match up with a solution? The first really obvious one is this. Savings gap, facilitate savings. Amazing, right? And then the second, primary product dependency, give me a forward market to fix it. Those are my 2. I don't want anything but that, by the way. Those are the best 2. You can fight me over it if you want. They are the best 2 points. So let's deal with how you actually answer this question. Yeah. One of the things that I need you guys to do, especially if a question is a bit more challenging, but you should do it for all the questions, it's good exam technique, is to use the wording of the question and throw it right back at the examiners to be like, here you go, right? I'm answering your question. And the topic sentence needs to basically tell me what it is that your point is. If I'm an examiner, I'm reading this, I need to know what your answer is in the first sentence of your paragraph. Yeah. It would basically say something like this. One role or one way in which the financial sector can help to promote growth and development, so I'm paraphrasing this, can help to promote growth and development is by facilitating savings or is by filling the savings gap. Both of them work perfectly here, yeah? So I'm going to say it's to facilitate savings. Right. My topic sentence is the point, right? So my point is that they facilitate savings. What I now need to do, this is why this is a kind of awkward technique-wise, is now I need to identify what the problem is, but not labor that too much, because then the paragraph will become too long, yeah? Briefly, you need to explain what the issue is, which is the savings gap. You go, according to the Harrod-Domar model, the savings rate in developing economies tends to be low. And one of the reasons for this is a lack of banks in these countries to enable individuals to save. Right, that's it. I now go, as such, if banks were to set up in these economies, it would make it easier for individuals to save. And therefore, a higher level of savings would allow banks to lend out more money to businesses within, let's say, the Ivory Coast, as an example, yeah? Whichever country, yeah? Higher levels of investment is likely to result in more growth and development. And then you're in comfortable, happy land. Why are you in comfortable, happy land? Because now you're basically going to go, investment is a component of AD, and therefore an increase in investment is likely to cause AD to shift outwards. It is also a injection into the circular flow of income. And so there will be a positive multiplier effect. You can define the multiplier here. You can talk about the fact that it's a massive multiplier because they are a developing economy. You then talk about how it could also increase the productive capacity of the economy because investment into new technology improves the productive capacity. You can draw AD, you can draw LRAS, don't do both, do one, right? Go crazy, right? Now you've got crazy levels of debt for that 15 marker. Your first analysis is now exceptional. And it was only exceptional, by the way, because you took the time to plan it. You sat there, you thought about the question, you considered what the question was asking, and then you went and wrote quickly. You take your time to think, you write like your life is on the line. I need you guys to write at rapid speed in this exam, yeah? It is very time pressured, as I'm sure some of you will have realized in the first paper that you just sat, yeah? Right, let's evaluate. What's the evaluation specifically to that point? Evaluations here are not straightforward because they're not like completely like theory, like it's not like, oh, but this is the solution or whatever. So what is the problem here? What is the evaluation here? The evaluation is, if you noticed, I worded my analysis in a very specific way on purpose. I purposely didn't tell you guys because I don't want to like give away everything straight away. But remember we talked about the savings gap earlier in the 25 marker that we wrote together, yeah? The savings gap is not just caused because of banks not being in the economy. Why were the banks not there in the first place? It was because the GDP per capita in these countries is very low, and the marginal propensity to consume is therefore very high. In other words, this doesn't actually address the root cause of the problem. The root cause of the problem is that people don't have enough money to save. Therefore, it doesn't matter. If you put a bank in the middle of a slum in India, are people going to save in that area? Of course they're not. They don't have money to save. Therefore, the evaluation is, however, the financial sector is an imperfect solution to this problem. This is because the lack of savings is not just caused by a lack of banks, but is caused by a lack of a lack of money, a lack of earnings. And then you develop that. Does that make sense? That is a brilliant evaluation, by the way, for this. Second analysis, now we talk about prime product dependency and forward markets. So the topic sentence will be something like this. Another way in which the financial sector can help promote growth and development is by providing forward markets. Briefly now, you explain the issue, which is many developing countries such as the Ivory Coast are dependent on the export of a primary product such as cocoa. Now, the main issue that we're addressing here is volatility of prices, right? The price of commodities tend to be very volatile as they are extremely vulnerable to external shocks such as adverse weather. Full stop. And so actually just one more thing. And thus the level of investment tends to be low as it's hard to plan ahead. Okay, I've given you context. I've given you like what the problem is. Let's solve it. We solve it with forward markets. The forward markets help to alleviate this issue as farmers can in advance agree to sell their commodity for a fixed price in the future and they're guaranteed to receive this price regardless of what happens to the market price. This makes it far easier for these farmers to plan ahead with more confidence, and therefore the level of investment is likely to rise, which can increase the productive capacity of the economy and therefore economic development up again. Beautiful. That's our second analysis. Let's evaluate. Well, the evaluation here is, there's a generic evaluation here. You can always, by the way, identify certain limitations that are still not resolved here. So one of the limitations is that the education levels in the economy still are low. Therefore, if the workers are still low skilled, it's still a problem. You can still say that, yes, it makes it easier for them to plan ahead, but they still suffer from the fact that their terms of trade, according to Prebish Singer, are still bad, right? A bit long, to be honest, maybe for this, although sympathy Marcus and maybe. I think, so Prebish Singer normally would be like analysis, but I think what could be a really easy point here is to say, look, actually, if the education levels in the economy tend to be low, then realistically, there is going to be a lot of financial illiteracy. In other words, a lot of people within, I mean, by the way, this doesn't at all just exclusively mean developing economies, even here, like in the UK. I mean, I'm turning 34 this year. I genuinely learned about what an ISA was like about a year ago. Like, you know what I mean? Like, most people are not financially literate. So the point is that even if they have the option of utilizing forward markets, will they necessarily actually take it up? A lot of them probably will not. A lot of them may not understand fully how to do it, and they might mistrust the system. If imagine like a foreign company comes up to you, like a British bank goes up to a farmer in the Ivory Coast and goes, "Hey, sign the contract, and you're going to get a certain price for your commodity in advance. I guarantee you, you're going to get this price." There's a lot of mistrust, and probably that mistrust is exacerbated if, for example, the price of the commodity goes up, and then they end up getting it at the lower price and go, "Whoa, I got conned," right? In other words, the evaluation, very simple, is that education levels are still fairly low. And the consequences of that is that the uptake might be low for forward markets. It may not be a perfect solution again. Clear? Hopefully that clarifies and now makes probably the hardest question so far in your paper a little bit less horrifying. Yeah? Okay, right. We are at 9 o'clock, but I'll keep going. You guys, I'm sure, are very tired. But we'll carry on a little bit more. So there's that. Okay, right. Can I carry on a few things about economic development? Because I'm hoping that it does come up as a 25 marker in your paper, either on paper 2 or possibly in paper 3. So let's do another 25 markers on development. The other 25 marker on development would be something along the lines of this. Evaluate interventionist strategies to promote economic development. Right. So again, evaluate interventionist strategies to promote economic development. Obviously, you'd have to use a country of your choice or a country. We're going to use the Ivory Coast again. Yeah. Right. Some of you might right now be going, "What in the world is an interventionist strategy? I have never heard of that in my life." When they have asked questions about economic development in the past, they haven't specified about the strategy being interventionist or the opposite, market orientated, or there's also a third category called other. They've normally left it to you guys to choose. And I hope that that will be the case because that would be ideal. But they can, and they are well within their rights to specify a type of interventionist or type of strategy, sorry. Yeah. So let's talk about what the difference is. Interventionist is, from the name, where the government intervene and play a more active role in promoting development, essentially growing from within. Yeah. Another name for interventionist strategies is therefore inward-looking strategies. The alternative is outward-looking strategies, or more likely to be called market-orientated strategies. Okay, I will deal with both in the event that one of them is a 25 marker. Let's start with interventionist. If you get a question about interventionist strategies, the first analysis that is unbelievably straightforward that I want you to start with is invest into education and training. Okay, you guys hopefully are starting to realize how many times we're going to talk about education and training. I could use education and training to become more competitive. I can use education and training to achieve economic growth, to reduce unemployment, to increase productivity. I could do like education training for most things, right? Economic development, yeah? Okay, again, we go through the key buzzwords again. We talk about how, for example, it raises the level of human capital. We talk about how a more educated workforce is likely to result in a reduction in unit labor costs, how you could basically upskill your workforce and maybe move them out of agriculture into sectors like services and manufacturing. So you're not as private product dependent, by the way, right? You can maybe reference like the Lewis model to some extent, but you don't have to. But anyways, there's a lot of things that you could speak about education and training. And the byproduct of education and training, as we know, is the LRAS curve shifts out, and therefore the economy grows and develops. Cool? That hopefully doesn't need me to develop it in much detail. You guys will know how to develop that. We know what the evaluation is to that. The evaluation to that is time lag. Massive, massive time lag, yeah? Now, if you had time in the exam, there is actually an alternative or a more detailed evaluation that you can give me than just time lag. Do you agree that investing into education and training programs is not cheap? It is fairly expensive. The government, therefore, are going to need to spend a lot of money. Hence, their fiscal deficit is likely to go up, right? Really quickly, what is a fiscal deficit? Fiscal deficit is where government spending exceeds tax revenue in a year. National debt, by the way, is the accumulation of all the unpaid fiscal deficits up to that point in time, yeah? So fiscal deficit is in a year, national debt is all the debt that you have up to that point in time. Now, within the world of bonds, now, if you guys don't understand what bonds are, very shameless plug, I apologize in advance for this, but honestly, like, you do need to watch this video. You need to watch my video about quantitative easing, yeah? Partly because I probably won't even have time to do quantitative easing today anyway, so to understand it anyway. But two is because I explore what bonds are. You need to understand that there's an inverse relationship between the price of a bond and the interest rate paid out on a bond. It will make a lot of sense when you watch it. But anyways, within the world of bonds, there are these institutions called credit rating agencies. Their role is basically to rate a country and therefore tell investors how safe that country is. In other words, if you lend money to that government and you buy their bonds, how likely are you to get your money back? The highest rating that a country can have is called a AAA credit rating. Now, a developing country obviously is not going to have a AAA credit rating. This is just me explaining the concept to you guys, yeah? From there on, by the way, I don't care about what the ratings are after that because it depends on the different agencies. Some of them have it as like AA+, some have it as AA3 and all of that. Just remember it as upgrade and downgrade from here on. Okay, so I just said to you guys that the government are going to need to spend loads of money here. Therefore, when they spend loads of money, the fiscal deficit goes up, their national debt goes up. So what might happen to their credit rating? Will it get upgraded or downgraded? The answer is that it might result in a downgrade in their credit rating. In other words, they might indicate to investors that, whoa, their debt is pretty high. You might be wary of lending money to this government. If their credit rating gets downgraded, that will translate, in theory, into the following. It may result in a decrease in demand for their bonds. If there's a decrease in the demand for their bonds, if there's a decrease in the price of their bonds, but that therefore translates into a higher yield, which is called the interest rate, basically, yeah? In other words, it is more expensive for the government to borrow money. Their cost of borrowing increases, and therefore it is harder for these governments to service their debts. That, by the way, is a phenomenal evaluation, yeah? If you ever get a question about fiscal deficit and national debt, one of the problems of having a high debt is the fact that it may lead to a downgrade in your credit rating. Vice versa, by the way, if you're dealing with a question where you're talking about reducing fiscal deficits and national debt, let's say they raise taxes or raise taxes or reduce government spending, then one of your points is the byproduct of that is that it may result in your deficit and national debt shrinking. Your credit rating might therefore go up. The demand for your bonds therefore might go up. The yield on your bonds goes down, and that's great for the government because their borrowing costs are lower, harder, it's easier therefore for them to service future debts. Is that clear? Anyway, so here I could have done time lag and I could have done credit rating downgrade, yeah, as an alternative, or even if you have time to do both. If it's 25 market, you definitely can do both, yeah? Cool, right, that's the first analysis and evaluation. Number two, second interventionist strategy. Bear in mind, by the way, there are plenty of interventionist strategies. I personally just think these are the easiest ones to do, the ones that have the most theory and the ones that you can evaluate very quickly without having to think too much about it. Number two is protectionism, big time, yeah? Protectionism is a very effective or very, very good interventionist strategy to talk about because there's a lot to say. There's a lot to analyze, there's a lot to evaluate, there's a million things that we can say. First and foremost, what is protectionism? Well, protectionism is where a country puts up barriers to trade. Examples include tariffs, which is a tax on imports. There's, by the way, again, sorry, shameless plug, there's a video of protectionism that we uploaded maybe a month ago. Number two is a quota, which is an upper limit on what you're allowed to come into your economy. And number three is a domestic subsidy. By the way, domestic subsidy, the reason why it's called protectionism is because you're giving an unfair advantage to your producers relative to countries around the world or producers around the world. So they would argue, look, they're only more price competitive than I am, those producers, because they're getting subsidized. So that's unfair. Anyways, I don't mind which ones you do here. But I think a good thing to potentially develop here is the infant industry argument. The infant industry argument, as I'm hopeful you guys know, but again, watch the video, is the idea that in certain countries, certain firms or firms in particular industries are currently too small to fully tap into the economies of scale that exist in that industry. Economies of scale, as I'm sure you guys know from paper one, is where you essentially like could bulk buy large quantities where you're operating lower down on your AC curve. So imagine the following scenario. Let's say that it was a car manufacturing firm wanting to set up in Ghana, yeah? If I compare their average cost to the average cost of, let's say, a Toyota. So watch this. So again, you will not draw this, by the way, in the exam. You're not going to draw it. Let's say this is the AC curve in the car market, yeah? Toyota, because they have huge amounts of market share, they might be producing somewhere down here. I'm going to call that Q Toyota, yeah? Whereby their average cost then is all the way down here at CT, yeah? Their cost is way, way lower because they can bulk buy billions of units of, let's say, steel because they're selling cars all over the world. They have huge market share. They make loads of cars, blah, blah, blah. Okay. Do you agree the Ghanaian firm has just set up and therefore they have very limited amounts of customers. They have very little, tiny market share to the point where, let's say the Ghanaian firm is here. So I'm going to call it QG. Their average cost is all the way up. I'm just not even touching my one. Let's extend it. It's up there. Okay. The problem then is this. If there were free trade, can the Ghanaian firm compete with Toyota on a cost basis? Absolutely not. Therefore, if there were free trade, the Ghanaian firm is likely to be pushed out of the market by the TNC as they can't compete on a cost basis. They have to shut down. Problem with that is twofold. One is it now means that the foreign company, in this case Toyota, can come into your economy and establish itself as a monopoly. This could lead to an exploitation of workers. It could also lead to them basically abusing consumers through high prices. But it also means that actually they are more likely to take advantage of things like transfer pricing, whereby they pay tax not in your country. They move their money out of your country and pay minimal to no tax whatsoever. Starbucks do that in the UK, for example, whereby they pay practically no tax. In fact, Starbucks pay less tax than expert tuition. That hurts, right? But the point is that they might use transfer pricing, and therefore the government don't have enough or generate any tax revenue to invest into things like the infrastructure of the economy, education and training, blah, 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 right? Therefore, the argument is the government should impose protectionist policies like a quota, like a tariff, to limit the amount of units that can come into your economy. And if it does that, that will enable the Ghanaian firm to now sell more. Because if you're in Ghana now, you have no choice. If there's a quota on the number of foreign cars that can come in, and you want a car, but it's super expensive to now buy a Toyota, do you agree that you're now open to buying the car from the Ghanaian manufacturing firm? Hence, the Ghanaian firm now starts to sell more output. They might produce at an output level somewhere, let's say over here now, so G2, and so their cost starts to come down. To the point where actually they might be able to compete on a global basis in the long run. And if they're able to compete on a global basis in the long run, that will help the government because it will generate more corporation tax revenue. They'll be creating loads of jobs in the economy, so therefore more income tax, etc., etc., etc. Loads of different paths that you can develop, but that I think is a pretty decent one to talk about the infant industry argument and how that can help to promote development, kind of growing from within. Help your economy by basically promoting your firms. Let's evaluate. In my opinion, the best diagram in the whole of theme 4, in fact, the whole of economics, both micro and macro, is the tariff diagram. And I want to make sure it makes sense. This is how you draw the tariff diagram. So we're going to have quantity, we're going to have price. It starts off with a standard supply and demand like this. The only small iteration that I always want you to show is now, instead of just writing just supply, you are going to write the name of the country that is imposing that tariff. So let's say it was Ghana in my example. So I'm going to write Ghana here. Yeah. And then this is the demand in Ghana. Right. When I say S Ghana, that means this is all the producers within the Ghanaian economy producing this good. Now, one of the assumptions in the in this diagram of protectionism is that firms globally become price takers. What that means is that you have to accept whatever the world price is as the price you sell this good for, because otherwise you could get this from anywhere in the world at that price, and no one will buy it off you unless you sell it at the world price. And we need to ensure that the world price is set below the equilibrium initially. You don't need to understand why. There is an explanation, but you don't need to know. Yeah. This is therefore the initial world price, WP1, and this is the initial world supply. There we go. This is how much is being supplied. And the reason why it's perfectly elastic is to illustrate, look, you can get this good from anywhere in the world at this particular price. Right, let's go through systematically, step by step, what this diagram is showing. The first thing is this, is that do you agree that it hits, can you see that world price hits supply over there? Is domestic supply high or is it low? The answer is that it is low. Look, this is 0. We're only producing a tiny amount. Why? What is the logic of why Ghanaian firms are not making much of this product? Well, the logic is that it's not an attractive price. For them, WP1 is not a great price. Remember, a supply curve maps out the various different prices that you're willing to sell, how many units you're willing to sell at different price points. Well, at WP1, it's not that attractive to sell it, so you're not going to sell that much. Domestic demand, on the other hand, is all the way over here. There's a huge level of domestic demand. Why? Very simple, because the price is really, really low. So imagine if I did this in numbers, imagine that we have 100 units being produced by Ghanaian firms, but the consumers want 500 units of this good. There is therefore excess demand of 400 units. What is that excess demand going to translate into? Well, if I can't buy the product domestically, where am I going to buy it from? I'm going to buy it from abroad. And if I buy it from abroad, that is an import. Agreed? Therefore, the distance between Q1 and Q2 is the initial level of imports. It's called M1. Clear? Now let's impose a tariff. A tariff, as we know, is a tax on imports. So that's going to increase the cost of production for firms selling the good within the economy into your economy. So the world price is now going to go up. We're going to have this. This is WP2. And now this is world supply plus tariff. Okay. Right. Again, same exercise as we did a second ago. Well, what's happened here? Domestic supply has increased. There is an extension along the supply curve from Q1 to Q3. Why? Again, logic. Well, at this higher price, domestic firms in Ghana want to sell more of this good. Because bear in mind, they don't pay the tax. They don't pay the tariff because they're not importing the good. But because the world price has risen, they're also going to raise their price in line with the world price. They go, okay, you know what? At this higher price, I'm down. I'll sell more of this. Domestic demand, on the other hand, is going to decrease to Q4. And therefore, the new level of imports is this, M2. Clear? We now basically identify, I always want you to do this, the following area. You're going to go A, B, C, D. Okay? Just in terms of revision, I want to make sure this makes sense. There are 3 players in any economy. Yeah? The best thing about this diagram, by the way, is it could be used as analysis and it can be used as evaluation. For analysis, there are 2 players here that are going to be winning. And for evaluation, there's 1 player that majorly loses. And overall, the economy is going to lose. Yeah? What I mean by that is this. There are 3 players in any economy. There's a consumer, there's a producer, and there's the government. Consumer surplus. Let's start with that. Consumer surplus. Okay. Consumer surplus, as I'm sure you know from your revision for the paper 1 exam, is the difference between the maximum price a consumer is willing and able to pay for a good and the actual market price they pay for the good. The easiest way to do this, by the way, is through like a 3-dot exercise. What I mean by that is you go, okay, which curve is the consumer, supply or demand? Well, obviously the demand curve, right? So the maximum price that consumers are willing to pay is where the demand curve hits the price axis. See that point there? That is the upper limit of what they're willing to pay. I'm going to put a dot there, right? So that's the maximum they're willing to pay. What price do consumers initially pay for the products? Well, initially consumers pay WP1. That's my second dot. I now go across from there until I hit the demand curve because that's the number of units consumers are going to buy. Whether it's domestically or from abroad, that's the amount of units they buy. So they go across there. Initially then, my consumer surplus area is here to there to there. Do we agree? That is my initial consumer surplus. Okay, let's do the exact same exercise, but now with the new world price. Well, the maximum price the consumers are willing to pay, has it changed? Well, no, because the maximum price is still there. 1. The second dot, if you like, or in this case square, is going to be the actual price they pay. Well, they now pay WP2. There. Then I go across from that point until I hit the demand curve. 3. The new consumer surplus area then is here to there to there. What happened to consumer surplus? Can you see the consumer surplus goes down by minus A, minus B, minus C, minus D? Consumers get demolished here. They have a significant fall in their surplus. Clear? Let's now do the producer. What is the definition of producer surplus? Producer surplus is the difference between the lowest price or minimum price they're willing to sell a good for and what they actually sell the good for. Which curve is the producer, supply? And we're looking obviously from the perspective of the country, like Ghana's producers. What's the lowest price they're willing to sell it for? Here you go. That's my first. I'm going to do it as like a circle. Yeah? What price do they actually get initially? They get WP1. So this is the second dot. And then I go across until I hit the supply curve. So the initial surplus area for producers is a little triangle over here. Yeah? Okay. Let's do the same exercise again, but now with a new price. What price are they willing to sell it for? What's the minimum? It hasn't changed. It's still this. I'm going to do it like a big triangle. Yeah? But what has changed is the world price has gone up. So now they get this. Yeah, that's my second. And then I go across from that point until I hit the supply curve there. What happens to my producer surplus? It used to be this. It's now, this. What's happened? It's gone up by area A. Producers therefore gain. So you know in the analysis, when we talked about infant industries and protecting it, you could have referenced that. You could have said, for example, therefore producer surplus will go up by area A and then passing, yeah? I would, for this, by the way, I would have my analysis for why protectionism is good. I would then sandwich the diagram between the analysis and evaluation and have it referenced both in the analysis and the evaluation. Does that make sense? So you put it in between the 2 points and then you can keep referencing it. All right. The last player is the government. And the government receive tax revenue whenever there's a tax. All right, how do I calculate how much tax revenue they make? Well, I need to know 2 things. An import, or a tariff, sorry, is a tax on imports. I therefore need to know the new level of imports, and I need to know what the tax is. Well, do I know the new level of imports? Yes, I do. It's the distance between Q3 and Q4. So the width of the area is this. The height of the area is the difference between world supply and world supply plus tariff. It is this area, area C. Can you see that? Because the width of the area is the level of imports. The height of the area is exactly the tax, the tariff. The government therefore gain C. Now the net effect, if I were to now basically go through all of the different components here, do you guys agree that minus A and plus A cancel one another out? Do you agree that minus C and plus C cancel one another out? What you would end up with is minus B minus D. You end up with 2 welfare loss triangles. And there are 2 reasons why. One is Consumers in that economy now have a lot less choice and face higher prices. You're restricted to buying things domestically. And the problem with that is that it also ensures that inefficient Ghanaian or domestic firms in this case, who would not have survived under free trade, are now kept in the market, continuing to produce a pretty rubbish product. Therefore, the quality of goods may also deteriorate, and thus allocative efficiency falls. I know that's micro, definitely can talk about it, yeah? It reduces allocative efficiency, consumers are worse off. Living standards are likely to go down. It's going to result in consumers in that economy having less choice. It's going to result in firms in that economy finding it more difficult to import the capital machinery required to develop sectors like manufacturing. This is why you argue protectionism is not a good idea as the evaluation. And this diagram will do a lot of the heavy lifting for you. Cool? Right. Amazing. That's the 25 marker in a nutshell done. If I were doing this, by the way, I would basically talk about how perhaps the best strategy here, if it was a judgment, by the way, is education and training in particular, because what it will do is it will allow you to develop from within, but also you can become more competitive. And it's going to attract more TNCs in the process because they want to basically come to an economy where education levels are high. Something like that. Yeah? Okay, right. Let's do the second last 25 marker. And then I think we might have to, unfortunately, call it a day. As much as I've enjoyed this, I'm exhausted. Right. So, I will quickly have a whiz through the Q&As in a moment, and I'll do my very, very best, by the way, to answer as many of you guys as I can. If I don't answer them, I really apologize. I'll do my best to do what I can to answer them. But the last 25 marker that I want to prepare for is something along the lines of evaluate market-orientated strategies to promote economic growth and development. Okay, very quickly, let's talk about what these are. Market-orientated strategies is where the government tries to take a step back. Yeah, they basically are going, okay, let's leave it to the free market and allow the economy to grow by taking an outward-looking approach now. Let's try to basically trade more. Let's try to give firms more of their profits and all of that. There are 2 points that I always wanted to do. Number one, the first is promotion of FDI. The first point is you want to try and encourage TNCs to come and set up in your economy. The way you can do that is that you could, for example, offer lower corporation tax. You can also create something called the tax haven, where you say, okay, look, for a certain number of years, any firm coming and setting up in my country, I'm not going to charge them any corporation tax for, let's say, the first 5 years. So these TNCs might now come and set up. TNCs coming and setting up in your economy, you can now develop in 2 easy ways. One, investment, as you know, is a component of AD. AD shifts out, injection, multiplier, all of that lovely stuff, right? We now have to develop that. But there's another thing that I think is really clever here, which is to say that when TNCs come into your economy, it may be in their interest to improve the infrastructure of the economy. And if they improve the infrastructure of the economy, this increases the productive capacity of the economy and leads to external economies of scale. If, for example, a hotel chain sets up in a developing economy, do you agree that, let's say Hilton set up, they would want to ensure that their customers can go from the airport to the hotel smoothly? And if the roads are all broken and really bad, they might now invest into improving the roads. But does that exclusively benefit Hilton? The answer is no. Obviously, it will improve it will reduce cost of production for all of the firms within their economy. Does that make sense? So that would be a really strong chain of reasoning that you could develop, and that also leads to economic development. Right, the evaluations to this are any of the bad things about FDI. You could talk about infant industries being demolished by TNCs. You could talk about how the FDI may result in abuse of workers. It might result in environmental degradation because the TNC might come into the economy and take advantage of all the natural resources that you have, but not care about the environment. Blah, 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 blah. Those are all valid evaluations. 2. Second, outward-looking strategy that I want you to do is trade liberalization. Trade liberalization is basically where you remove barriers to trade, like a tariff, like a quota, subsidies. You start to become a more active participant in the global economy. You might, for example, join a trading bloc, because if you join a trading bloc, it will lead to trade creation. And if it leads to trade creation, it could be because you can tap into your comparative advantage. You can specialize. You can have a more efficient allocation of your resources. You can operate outside of your PPF. You can go crazy, right? It's amazing stuff that you could talk about here, right? So trade liberalization can also lead to economic development because of the fact that by having more trade, it can lead to export-led growth. AD can shift out. The government can generate more tax revenue from all of this, etc., 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 which they can invest into, improving education system, and therefore HDI ranking might go up. What's the problem with trade liberalization? Problem of trade liberalization, I think, a good point is to say this, is to say, however, the problem that these countries have is that their comparative advantage is in primary products. They are primary product dependent. And therefore we bring in our new bestie, well, two besties, Krebish and Singer. And we go, oh, actually, if these guys specialize in what they have a comparative advantage in, the byproduct of that is that their terms of trade might actually decline over time. They might struggle to import materials like raw materials and import capital machinery. They might struggle to import over time because of the fact that they are reliant on this export of a primary product, and that is bad for their terms of trade. I want to develop a Krebish Singer hypothesis, as I did earlier in the video. Yeah? Right. That would answer that question very thoroughly, and hopefully that makes a lot of sense in terms of what you do for economic development. Right. Let me go through a couple of your questions as quickly as I can. If they are a little bit long, I might not be able to answer it. I'd be really sorry. I will do my best. What is the difference between GNI and GNI and GNP and GNI per capita as part of the HDI index? You don't really need to know, by the way. So to be honest with you, like you just need to know the different measures of economic development, like economic growth, GDP, GNI, GNP. Very briefly, this is very unlikely to be like a big question, by the way. It's very likely to be a multiple choice at most, and maybe like a 2 marker. The one I believe they use for HDI, but don't quote me on this, it's worth actually checking, is GNI per capita at purchasing power parity, PPP rates, yeah? They actually changed it. They used to use GDP, but they changed it about 8-10 years ago, I think it was. But you don't need to really, just know it as living standard. Like a GNI is a measure of economic growth, yeah? Should you talk about J-curve in the first point and evaluate with Marshall Lerner? No. Marshall Lerner and J-curve will come together, please, yeah? Marshall Lerner is the first part of the evaluation. J-curve is the second part of the evaluation. If it's a 10 or a 12, you're done. You've got your evaluation marks. 15 marker or 25 marker, pretend it's one evaluation. And then do something else, the second evaluation. If it's talking about appreciation, do you still talk about revaluation as technically a different thing? No, if it's an appreciation, you say it's appreciation, yeah? But if it's a revaluation, then you're talking about it. So if they're intervening to cause the currency to get stronger, we'd call that as a revaluation. But if it's free market forces, like the question in Brazil, then we would basically talk about it being a appreciation. Really quickly, actually, that reminds me, I want to do one more thing. I keep saying on the end, but I just want to make sure you guys are ready for the exam. Let me quickly find the Brazil question again. Where is Brazil? Not here. Got a million tabs now open. Here we go. Right. So, you know, the Brazil question was about an appreciation. Am I showing my screen? Is it my board or is it this? Yeah, okay, right. You know how the Brazil question is about an appreciation. The Marshall Lerner condition is still the Marshall Lerner condition. It still says that the average sum of the price elasticity of imports and exports must be greater than 1. But in the beginning of it, I'd be saying, however, for there to be a worsening of the Brazil's current account, in this case, because it says it appreciates, the Marshall Lerner condition must be satisfied. Explain it. And then the diagram in terms of the J curve would actually look like this. So let me show you. So time, current account, positive, negative. Okay, right. So let's say that they start off in a deficit over here. Remember how I said the way to figure out the shape of this curve is to say whatever I just said happens in the analysis, the opposite will happen first. Well, here, it was an appreciation of the real. So we'd say they're less price competitive, exports go down, imports go up, current account deficit will worsen. Therefore, what is the opposite? The opposite is the current account deficit does not worsen, it gets better. So it's going to go up first and then down. It's like an upside down J, I guess. You don't call it that, you just call it the curve if that comes up, yeah? So if it's an appreciation or a revaluation, you're just going to say the curve shows that initially Brazil's current account is actually likely to get better because they're stuck in trade contracts and all of that, yeah? Right. Evaluate the effectiveness of quantitative easing during a significant recession, the 2021 paper 2. Okay, right. Can I answer this very quickly? 1, watch my video about quantitative easing. If you understand what quantitative easing is, the question now is changed to the following. It says, evaluate the impact of low interest rates on an economy. Yes, it doesn't matter, by the way, that it was in a recession. You just have to link it to the recession. And the way you answer that, oh, by the way, sorry, selfish plug, crazy plug it. In fact, there's, I think, an 18 or 12-minute video, it's a long video, of me going through a monetary policy essay. And it becomes that essay for you. So you literally watch those 2 videos and you will now know how to answer it. One of your paragraphs, by the way, will be about the impact of low interest rates on consumption and investment. And the second paragraph is going to be about the impact on exports and imports, hot money, all of that. And you'll evaluate with 2. You'll get 25 out of 25 now. Yeah, watch those 2 videos, easy peasy. Right, how important is it to walk into the exam with case studies and figures? It's a good idea to have a couple, but don't really, like, look, you have 1 day left of revision, yeah? Your priority by far at this stage is to prioritize theory and developing chains of reasoning, yeah? I shouldn't really say this, especially on a live, like because it's recorded, but within reason, you genuinely can make stuff up. Yeah, as long as it's not ridiculous. Yeah, have a couple of stats to hand, but you can get away with like approximately this. Oh, their debt to GDP ratio is roughly this. Yeah, um, obviously have a couple of facts. If I were you, just look at the stats that I gave you guys on Instagram. I gave you a couple of stats for the UK and for Ivory Coast. You're done. You're good. You're golden. That's everything, right? Because you don't need to like reference so many things in the 25 marker. As long as you contextualize it around the country. Application marks are also diagrams, by the way. So that counts as application too. Cool. Hopefully that puts you guys at ease. Can you not talk about specialization for this question? I have no idea what question it is. I'm really sorry you asked that a long time ago. Maybe. I don't know. Should you ever do 25 markers with 3 analysis and 3 evaluations? Okay, right. I'm glad someone asked this. The answer is so definitively no. And can I clarify why it is so badly no, especially if you do Edexcel? The way they mark your 25 marker and all the subjective questions, 10, 12, 15, and 25 markers, is they read the entire essay. They read the entire essay and they now put you into a level for analysis and a level for evaluation. The key is not to make loads of points. It is to develop your points in as many chains of reasoning as you can. 25 markers is all about depth. Blag it out. Just give me multiple chains of reasoning, right? And if you do that, what that will do is it will put you into the highest level. So let's say hypothetically you've done 2 analyses and both analyses are in level 4, which is the highest level of analysis. Great. That's exactly where we want to be. But you decide, you know what, I have a bit of time in the exam and I'm going to chuck in a 3rd analysis. And that analysis, partly because you don't have enough time to develop it, is not amazing. It's okay. That analysis, let's say hypothetically, is level 2. Do you know what now happens? It now drags your entire analysis down because they have to read the analysis and they have to basically now give it an average of the 3. Never ever do it. Never do it, no matter what. I don't care how tempted you are never doing 2 analysis. Yeah. Again, on our Instagram page, we talked about I've gone through like various questions, the number of points you need to do, and how many minutes I expect you to take per question. Please read it. If you haven't, it will help you out. Yeah. Is that clear? Can I do a question for the video? I'm really sorry because of time, but please watch the videos. It honestly will answer the questions so thoroughly for you. If it still doesn't, please email me and I will go through it. Does your evaluation have to relate to your KAA? Could it be general disadvantage, for example? Okay, good question. If your other exam boards, usually yes, AQA in particular, are very specific about it being specific to their point that you need to evaluate. Edexcel are a lot more lenient, yeah? Whereby they will allow you to just do just the other side of the debate, yeah? So it doesn't have to be specific to the point you made. If it is, even better. But for example, Marshall Lerner Jacob is very specific to the point that we made, but it's okay if it's just like the opposite, like the bad things, yeah, or the good things, yeah? How do you answer a question on happiness? You watch the stream, you smile, you get happy, right? I'm joking, right? Let's go through it really quickly. This was asked at a 10 marker last year. It was asked at a 10 marker in 2019, I think. I'm pretty sure it's 2019. Right. The answer is the same every single time. Higher income is likely to result in higher happiness. Can I clarify why? Because when you have more disposable income, do you agree you can spend more on basic necessities? You can also spend more on luxury items like a holiday. This therefore increases your utility and therefore you feel happier. Wowee. The other thing that you could talk about is that if you have higher income, do you agree that you're less likely to need to borrow money from banks and loan sharks, and therefore you have less stress in your life? Whereas if your income is falling, you're more likely to need to take out more loans. More loans equals more stress in your life. More stress in your life is likely to result in you being unhappy. The evaluation to that is every time the same thing. Easterlin paradox. The Easterlin paradox is a fancy way of saying something really basic, by the way. The Easterlin paradox is the idea that as your income rises, your happiness tends to go up, but only up to a certain threshold. Beyond a certain amount of income, when you have more earnings, your happiness doesn't actually go up. There are other factors that will make you happier, like, I don't know, your family and whatever, like football, right? Unless you're an Arsenal fan, which you're probably not happy right now. Come on, United. Right, anyway, so point is that's the evaluation. There's not necessarily a definite correlation between the two. So does that make sense? Yeah. Another thing that you could talk about, by the way, here is that, people who are really high earners, yes, they're high earners, but do you agree their jobs typically are also a lot more stressful? So then they might not necessarily be happier. Cool. There you go. 10 out of 10. Can you explain a structural deficit? Right. Okay. In terms of structural deficit, there's the fiscal deficit is broken up into 2 parts. So fiscal deficit, as we know, is where government spending exceeds tax revenue in a year. The cyclical deficit, so you guys remember from theme 2, I keep saying we're going to end this live stream, but here we are again. And it goes like this. We have time and GDP. This is the trend rate of growth. This is what your economy is expected to grow at on a year-to-year basis. And then this is the reality of how it grows, yeah? Real GDP. The cyclical deficit basically is the deficit or the part of the fiscal deficit that will automatically adjust based on where you are on the business cycle. So for example, if the economy falls into a recession, the UK somewhere over here, do you agree that automatically the government are going to collect less tax revenue? There are going to be more people unemployed, so less income tax, less corporation tax because firms aren't making as much money, etc., etc. So they're going to receive less tax revenue, and automatically they're going to be paying out more unemployment benefits because more people are unemployed. The cyclical deficit then would get bigger. Yeah, does that make sense? The fiscal deficit will get get worse, just based on where we are on the business cycle. Vice versa, when there's an economic boom, they're going to collect more tax, spend less, and on unemployment benefits, so the cyclical deficit gets better. Yeah, that's cyclical deficit. What is structural deficit? Well, if cyclical is where the government didn't do anything and the deficit adjusted, the structural deficit is where they actively do something that causes the deficit to get bigger. For example, during COVID, the government spent loads of money because of furlough. And that, therefore, the byproduct of that is that this deficit rose. That is a structural deficit. Makes sense? Yeah. So if they cut spending, as an example, that would reduce the structural deficit. Please, can you go through the financial sector later? Market failure. All right. One of the things I didn't go through in the financial sector is the impact of market failure in the financial sector, which is a hard essay. However, I have written this essay for you guys on our website where you have resources. You know how you have essay packs? There is a free version of the paper 3 one. Please download the free version. If you're not sure where to get it, just email us and we'll send you a copy. I might even actually try and put it together and publish it on Instagram in the next day or two. I'll see if we can. But anyways, I've answered basically what I regard as the worst ever question that could ever be asked. It was evaluate the microeconomic and macroeconomic effects of market failure in the financial sector. Horror question. Obviously, it won't be macro for paper 2. That would be paper 3. But obviously, take the macro points and use it. So I've basically answered it for you guys. So please read that essay. Okay. Right. I am trying my best to go through as many of these. All right. I've done these. I've done that. Okay. I've done. I hope I have. I'm really sorry if I'm not answering your question, by the way. Will there be another session? Yes, there'll be one ahead of paper 3. I don't remember what the date is. It will be announced very soon. How does a floating exchange rate lead to growth and development? Yeah, I wouldn't do floating exchange rate if I'm being honest with you as my strategy to promote growth and development. I mean, if they let it float, then perhaps what happens is that when it depreciates, they're more price competitive, exports up, imports down. But I wouldn't do this. That's not a good point. Yeah. Okay, I missed the conclusion in the micro paper. Managed everything else. You're not going to be capped if you haven't written a judgment, but it just affects like how high up you are in level 3 of the evaluation. So don't worry, it's not a big deal. Try obviously for the macro exam to make sure that you guys do a judgment for the 25 marker. How should we revise at this point? Okay, that's a good question. Right. Okay. Tomorrow, you should probably sleep now after this. You need to rest. But after this point, I think if I were you guys, the first thing I would do is I would print, if you have a printer, 2 section A's, any random combination of 2 section A's, A2 ones though, yeah? So either like say 2018 and 2019. Sit it in one sitting, it'll be out of 50, yeah? Right, I don't know whether you guys understand this or not, yeah? You guys are here to get an A star. You're not here to get anything less than an A star. I'm not interested in anything less. You guys are all capable after this of getting an A star, therefore you're gonna do the following. If you do section A under time conditions, you mark it, because it's just right and wrong, there's no in between. The minimum mark I hope that you guys should be hitting is 42 out of 50, yeah? Ideally 21 out of 25 basically for each 25 marker. If you haven't hit that, you're not ready yet. Your theory is still not good enough. You need to revise and understand what your mistakes are, go back and over it. I actually think section A in paper 2 is harder than section A in paper 1. There's a lot of nitty gritty stuff that you need to know. Like, for example, they can ask you a 4 marker about, explaining how they calculate inflation using the CPI. So you need to like memorize the fact that they basically conduct 2 surveys and all of that. Yeah, that's the first thing that you guys do. The second thing that you do, you are a little bit short on time because obviously the exam is on Monday. But everyone's in the same boat, by the way. The turnaround between paper 1 and paper 2 is really unfair this year, but what can we do about it? It's the same for everyone. If you have time, sit a whole section B under time conditions. If you want me to pick a paper for you, June 2017 is a good paper. If you want to do an old spec paper because you've done all the new stuff, June 2015, there's a question about India. Brilliant question. Do that question. Yeah. If you've done that as well, June 2012, unit 4, the question about the Eurozone. You're welcome, right? Go and sit through those. If you don't have time to sit a whole section B under time conditions, which is perfectly understandable, go through as many section Bs as you can and just plan the questions, compare it to the mark scheme and see that you're hitting the points and you know how to develop those points, yeah? Do that. Honestly, if you do that, macro is very repetitive. to the point where you will be in a position where going into the exam on Monday, you genuinely would have seen about 75 to 80% of your paper because it'll be the same questions just asked in a slightly different way. Cool. Right. I am so really sorry because I am so tired. And I'm really sorry. It's taking this 2 hour 40-minute session. The very last thing, just in terms of the Phillips curve. The Phillips curve for Edexcel, you do not need to know in any meaningful detail. It is just showing the inverse relationship between unemployment and inflation, how they conflict. Other exam boards, Educas, AQA, OCR, you guys need to know the Phillips curve in a lot more detail. But obviously we are unfortunately a little bit tight on time. I really apologize. I'm really sorry. There's so many questions. I hopefully covered a lot, I hope, in the session, and I hope this was really useful for you guys. And I apologize. I feel really bad that I wasn't able to answer all of your questions. Are you able to, very quickly, sorry, are you able to use the Marshall Lerner and J-curve valuation for appreciation? Of course, yes. You could use it for appreciation, revaluation, devaluation, and depreciation. Always. I want you to use it, yeah? But just be wary of the fact that if it's an appreciation, your wording is slightly different. The Marshall Lerner condition stays exactly as it is, but then you know the explanation I did afterwards, it will be, this is because every unit exported is now, in this case, if it's appreciated, cheaper. Whereas more expensive, whereas every unit imported is now cheaper. All right, guys, good luck. Go and smash the paper on my